is getting colder, strangers passing by. No one offers you a shoulder, no one looks you in the eye. But I've been looking at you for a long, long time, just trying to break through, trying to make you mine. Everybody wants to flame, they don't want to get burned. Well, today is our time. Days like these lead to nights like this, lead to love like ours. You're like the spark in my bonfire heart. People like us, we don't need that much, just someone that starts the spark in our bonfire hearts. Someone that starts the spark in our bonfire hearts. Days like these lead to nights like this, lead to love like ours. You're like the spark in my bonfire heart. People like us, we don't need that much, just someone that starts the spark in our bonfire hearts. Days like these lead to nights like this, lead to love like ours. You're like the spark in my bonfire heart. People like us, we don't need that much, just someone that starts the spark in our bonfire hearts.
When I need motivation, my one solution is my queen, cause she stays strong. Yeah, yeah. She is always in my corner, right there when I wanna. All these other girls are tempting, but I'm empty when you're gone. And they say, do you need me? Do you think I'm pretty? Do I make you feel like cheating? I'm like, no, not really, cause oh, I think that I found myself a cheerleader. She is always right there when I need her. Oh, I think that I found myself a cheerleader. She is always right there when I need her. She knows like I'm a dove. She grants my wishes like a genie in a bottle. Yeah, yeah, cause I'm the wizard of love, and I got the magic wand. All these other girls are tempting, but I'm empty when you're gone. And they say, do you need me? Do you think I'm pretty? Do I make you feel like cheating? I'm like, no, not really, cause oh, I think that I found myself a cheerleader. She is always right there when I need her. Oh, I think that I found myself a cheerleader. She is always right there when I need her. She gives me love and affection. Baby, did I mention? right there when I need you.
Hello and welcome. and it is time for our investor breakfast. So we are doing our virtual investor breakfast, and we are really, really excited to have you online. My partner, Gabriella, is going to be joining us soon in terms of this. But what I wanted to get going with, and you can see that the countdown clock has now got to where we're at. But just as we're starting here, you'll see that on this page, there's a whole bunch of resources. How do you sign up to the platform? Personal capacity, the company structure, the trust structure, how you get set up, the Wealth University, and the 4-step formula. So you can see there's a whole bunch of resources here that I'm going to put in. I'm also going to put in a link for you, because if you go to this page, which has all the different resources, and includingly has the wealth plan printout. Now, this wealth plan printout is important because you need this for one of the exercises we're going to do just now. So let me get started and put it in the chat box for everyone and panelists and attendees, and you should have that link. I'd suggest that you go, and if you haven't done it already, download that. So this is the link. You can see here, it's got all the different resources for this breakfast. And you can see here that we've got signing up to the platform, all the different get started guides. And then we're going to talk about some of this other stuff later. And the wealth plan you can actually download. So I want to get started quickly, and I want to find out, where are you from? Sorry, I just see I wasn't sharing my page there. So let me just share this page so that everyone can see it. So you've got the resources page. This is signing up to the platform. And this is the beginner guides here that you've got. And then you've got the Wealth University, the 4-step formula, which we're going to talk about, and then the wealth plan printout. We're going to be working on this printout just now. So I want to know, where is everyone from? We've got people coming in from all over the world. We've got over 500 people that have signed up for this, whether you're watching it live or whether you're watching the session later this afternoon. We're trying to accommodate for both of the different time zones, people all over the world. And let's get right into the presentation here. Let's hide this. And we should have you rocking and rolling. So let's see. I just want to be clear quickly. Can everyone, so we've got South Africa, we've got the UK, we've got Botswana, we've got, where else we got? We've got Italy. So let's just let us know where you're from. My second question before we get started, or as we get started, is, are you hearing me loud and clear? Did you get the link to that page with the resources? And is there anything that I am not doing? So are you sharing? Are you seeing my screen? I just want to make sure that you should be able to see the Offshore Investor Virtual Breakfast. I just want to check that that is all live for you. Perfect. Well, I suggest we rock and roll. So very nice to have you all here today. And I'm really excited. We've got an awesome lineup to share with you in terms of what we're doing, how we're doing it, and most importantly, what it means to you. So let's rock and roll here quickly in terms of where we're at. And I want to get started. Depending on where you are in the world, it's hard for me from a time zone perspective. This is 7 a.m. GMT time. It's 8 a.m. UK time. It's 9 a.m. South African time. So just figure that out based on where you are in the world. I'm going to give you a team introduction. I'm going to introduce the team and how we're doing and what we actually are looking at. And then I'm going to be running through the why, okay? And it's about the theory, okay? So you might have heard this before, but repetition is the mother of skill. And so I'm going to be running through the theory so that you can learn all the theoretical understanding that you need. And then after the tea break, we're going to have a tea break where you go for, obviously we're in the virtual environment, so you can go get some tea, go to the, go get a coffee, etc., go to the toilet. And then we're going to come back and we're going to go into a practical session because we want you to leave with results. That's the most important thing. There's no point in having all the theory, but no results. So that's the breakdown. Now, my request to you, and this is a solid request, is that we're in the virtual environment. If you were live, we've just done breakfasts, 3 different breakfasts around the country. They were filled to capacity. And what was interesting is if you were live, the chances are you wouldn't have your laptop there. Your cell phone, you would probably take your cell phone like this and you would turn it upside down and you would switch off your distractions. Because my question to you, when we look at this, and sorry, just before we go into the team, when we look at this, is what's more important to you? Something or someone that is going to distract you in the next 4 hours of your life, or the rest of your future and how much freedom means to you? So what's more important to you? A distraction in the next 4 hours and kind of being partially here. And don't get me wrong, I'm not judging you. I do this all the time. I watch webinars and I'm sort of half there and I'm reading emails and WhatsApping people and looking on social media, and my attention's maybe 20% there. And that's fine. If that's what you choose to do, then that's your choice. However, I invite you, I encourage you to invest the next 4 hours of your life in your future and you setting yourself up for success, whatever your why is. And we're going to go into that, which is why you're here. Invest the time, your time and your concentration in that. Because if you do that, then you're going to get the results that you actually want. If you don't, then you probably won't get the results, and distractions will always have an impact in your life, and you'll always be wishing that you were somewhere else in life. So a lesson I've learned in life is get focused and get present. So who's the team with us today? My name is Scott Piggin. I'm the CEO and founder of the group. My colleague, Gabriella Farris, is going to be joining us. She is from Head of Revenue. We've got 2 wealth consultants in Alex Oosthuizen and Fritz Gross. We've got Siska, who is head of our KYC, which is Know Your Client. And we've got Ruth, that is also part of the KYC team. So they're the onboarding customer service team. And if you're dealing with our team, I always like to believe that we are a digital company with a human heart. So, and there's many more humans behind it, but I just wanted to put some faces to the names so that you've got an idea of who you're dealing with and how you're actually dealing with them. So let's go to the meat and bones. We're about to get into the secrets to wealth and how to use real estate and other alternative assets to become a global citizen. Now, I want to share with you a story. It's a personal story, and it's one of frustration. So I'm not sure who went out and 25 years ago read this book. It came out in 1997, as I understand it. So it's 24 years old. And this book, Rich Dad, Poor Dad, has shaped the lives of many, 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 many individuals. So do me a favor in the chat box and just put it up there if you've read Rich Dad, Poor Dad, and if this book had a meaningful impact in your life. So I'd like to just see it. Again, we're all over the world. We're in an engaging environment. The more you engage with me, the more energy I'll have, the more I can share. So I can see there, yes, I read it. My son has an autobiography copy. Yes, it's an excellent book. Yes, I've read it. Excellent. So hi all. Yes, I've read the book. So I can see that there's a lot of people that are like me. And so my parents actually gave me this book on my birthday in 2001. And they said, "Dear Scott, we hope you make your fortune, but more importantly, we hope you have good health, many friends, and lots of happiness. Lots of love, Mom and Dad." And what was really interesting for me is that I read this book and I sort of got the theory. I mean, if you go to this, the theory is this cash flow quadrant and how this cash flow quadrant actually works. And you can basically see here that, and I'm going to go into this in more detail. So let's talk about this just a little bit, because I think this is quite important. And most of you have read the book, so it's probably a refresher. But for those of you that haven't read the book, it'll also be interesting in terms of, someone says, yeah, I read it, and I'm sorry that I didn't read it in my 20s. Yeah, I was very lucky, Rachel. I read it when, I'm 44 now, And that was 20 years ago. So I would have been in my early 20s when I read the book. So let's look at it just in a little bit more detail, and then I'll explain my personal story. So to start off with, you've got the employee, and you can see here, if I move my mouse around, you've got the employee in this section here. You have a job. You've got self-employed, which is you own a job. You've got the business owner, which is you own a system and people work for you. And you've got the investor, where money works for you. Now let's go into this in a little bit more detail. In the E, the employee section, there's a picture of a person on a hamster wheel. And that's because you feel like you're on a hamster wheel. It's all hard work. There's no security and no time. And this whole section is about active income. You actually get paid to do something. The self-employed section, this is really interesting. Most people think to themselves, they want to go out and they want to start a business. They want to become a doctor, an accountant, a lawyer. But what's interesting is that they have no time, they have large debts, they have insufficient funds, and they have a hell of a lot of stress. And what's interesting is that all of these people on both sides of this quadrant here is about active income. They get paid to work. So as an example, my brother's a good example. He's an anesthetist. He's incredibly good at what he does. He studied for 16 years, but he's only as good as every operation that he can do. And what's interesting, and that's why it's, there's a picture here of a doctor. Most people aspire to be a doctor, and doctors get paid really well, but it's the hours that they can actually put in. And 95% of the people on this planet are on this quadrant, and they only own 5% of the wealth. Then you've got the people on the other side of the quadrant, and this is the business owner. You own a system and people work with you, and it's about easy work, stability, and spare time. Now, I'll be frank, and in the room, if I could see your faces, when I've said that, a number of people kind of laughed, me included, because I haven't quite figured out the easy work or the spare time yet. But anyway, supposedly that's the case. And but you can see here that it's about passive income. And then finally, you've got the investor quadrant, which is where there's no debts, plenty of money, and freedom. So the most important word that we're using here is freedom. And you can see that money works for you, and that, in this quadrant, 5% of the people on the planet have this, and they have 95% of the wealth. Now, if I come back to the word freedom, that's why I'm employing you and inviting you to switch off your phones, switch off your emails, switch off your social media, and get engaged. Because whether you're sitting in this quadrant, the employee quadrant, this quadrant, the self-employed quadrant, this quadrant, the business owner quadrant, every single one of you wants to get to here. And what we're going to share with you in the next 4 hours is not only the theory, but also the practical of how to do it, whether you're a beginner, an intermediate, or an advanced. Now, I want to share with you my personal story, because it'll probably resonate with a bunch of you, where 20-something years ago, I read this book and I went out and I literally did what the book said. Now, what did the book say? And how did most people kind of take it? So I was going to sip of water here very quickly. I read the book, and the way that I understood the book was that to build a passive income, I needed to go and buy a property. So there's another book to this series, which is Real Estate Riches by Dr. Dolph DeRose. And in that book, he said you needed to look at 100 properties. You needed to make an offer on, you needed to walk the streets. You needed to make, you needed to look at 100 properties. You needed to make an offer on 10 properties. You needed to get accepted for 3, and you needed to buy 1. They were the kind of the rough maths. And so, my story was probably very similar to the rest of you, where I understood the theory of what Robert Kiyosaki was teaching in this book. I understood the theory of the cash flow quadrant. But what I find was actually turning the theory into practical examples was extremely difficult, because I went out and I literally did it the hard way over 20 years. I mean, this was my first building project when I was 13 years old. I didn't want to share with my brother anymore. And so I convinced my parents that we should extend the house, and we put a double bedroom bathroom onto the project, onto the house. I then did my first proper development. I did a development when I was 19 at university, but I didn't have planning permission, where we converted a triple garage into 2 bedrooms, 2 bathrooms. My first proper development was when I was 22. We bought a house and we converted it into 6 townhouses. I then did my first London project when I was 24. It was in Wimbledon. You can see here, it was this one. It's a terraced property in here. And you can see it was back in 2002. And from that, what happened was a number of my friends came to me and they said, look, we're really interested. How are you doing property in South Africa? How are you doing property in England? Can you teach us? And so we started a company, International Property Solutions. And over the years, we helped thousands of people buy houses or apartments in South Africa. Then we had people come and they wanted to invest in England. And so we helped hundreds of people invest into England. And then we helped hundreds of people invest into Australia. And finally, we helped hundreds of people invest into America. But what we realized was that it was hell of a difficult to buy individual homes and apartments. Now, from my experience, and I owned 16 at one time, it's extremely, extremely difficult to manage all these individual houses and apartments. It's extremely difficult to manage them just in one place. And it created a huge amount of hassle in my life. And the next thing was, back to the theory, was that if you go and read all the books, it was obvious. It was, okay, well, I need to be in commercial property. And again, if I use the word property, real estate, it's the same thing. So I was like, but how do I get into commercial? And then when I did all the research, the theory, it was much more difficult to get into commercial. I needed to have a 30% deposit rather than often a 10% deposit in residential. And I just didn't have the money. And I didn't have the know-how and everything else. And so for me, it really summed up. And what I realized, having helped people for more than a decade, was that my problems were the same as all the other investors' problems. And that's that I, as an investor, was limited. I was stuck in country. Most often when I bought residential property, it would be the country, or not just for myself, but for the other investors, it would be the country that I'm familiar with is where I actually invested. When I started looking at commercial or international property, the barriers and the hassles were just tremendous. And that's not even taking into account tax, structuring, and compliance. And so what we realized was that the barriers were just too high. And then what happened was in 2008, 2009, we had the global financial crisis. And there was this opportunity in Wimbledon where Barratt Homes, you can see the developer in the top right corner there, Barratt Homes is a big, massive developer in England. And they got themselves into trouble in 2008, 2009. And these buildings, we could buy 48 units and they were at about 40% below the replacement cost. Okay, so that's a 40% discount. And they were fully furnished, fully tenanted. And I remember it being an absolute no-brainer. In fact, I actually sent out this email to all my investors. I had about 2,500 investors at the time. And I said, it's a 40% discount and 8% yield, £440 a month positive income. And I said down the bottom here, if you look at where my mouse is, I said, I don't care what happens with market values in the short term. This represents a real opportunity. And you know what frustrated me beyond belief is that I needed 10 million pounds. It was absolutely obvious to do this deal. I needed 10 million pounds and I ran around to all my investors and I couldn't get people to work together. And I lost this deal. In fact, I had the humiliation of going to see Barratt Homes personally and saying, listen, please, can I buy one unit? Because I could afford one unit. And they basically said no. Like, they literally laughed at me. They laughed me out the room. And this created tremendous pain because I understood the theory of Robert Kiyosaki. And I now understood how people were doing it, but I didn't have access. The second thing that happened was in 2009 as well. I was in Bondi Beach, Sydney, and I met two very, very wealthy investors, and I asked them what they were investing in. Now, remember, we were in the middle of the last financial crisis. People were running scared. People were even scared to put their money in the bank, as an example, because they weren't sure what was going to happen to banks. And they told me that they were investing in medical buildings. Now, if I ask you, other than Wealth Migrate, okay, and one of its partners, or Vest, or through our platform, had anyone on this webinar done medical before, ever? Have you even thought about medical as an option? Because I certainly hadn't. Okay, now I have a BSc construction management from UCT, which is a 4 years honors degree, cum laude. I have a master's degree from London University in construction technology, cum laude. I have the highest qualification for residential property out of the US. I have AIPP, which is the Association of International Property Professionals out of the UK, which is the highest qualification you can get out of the UK. I've literally done all the courses around the world on property. I've even done the highest one here in South Africa, which is the PDP, which is by the business school of here in the University of Cape Town. And what I realized was that I had all this theory, I had all this knowledge, I had all these degrees, and again, I'm not being arrogant, but cum laude, I had all of them. And no one had ever told me medical. So I said to the guys, why medical? Why? And they said, well, think about it. No matter what happens in the world economy, people need doctors. I was like, that makes sense. So interesting, even with COVID, it makes even more sense. Secondly, doctors never leave their premises. And I remember thinking to myself, that's the truth. You know, if I look back to my childhood, my doctor has passed away, but the medical premises are still medical premises. And thirdly, doctors make greater doctors, but they're not accountants. So they sign very good long-term leases. And again, I remember sitting there thinking, this is a no-brainer. This is an absolute no-brainer. Like, why was I not taught this in Property 101 in my very first week of my very first lecture? Because think about it. You've got a tenant that is economically resilient, that never leaves, and that pays a good rent. I mean, it's literally Property 101. So I said, right, I'm in. How do I participate? And they said, well, the problem is you need 5 million Australian dollars. And I was like, there is the problem. And I didn't have 5 million Australian dollars. And they went on to build a portfolio in Australia that was worth over 700 million Australian dollars. And these two pain points really helped me galvanize taking the theory that was in this book and realizing that I could have all the theory in the world, but unless I started to invest like the top 1%, I would not get the results of the top 1%. I could learn about that investor quadrant, the fourth quadrant down in the bottom right corner, but I would never get there unless I started investing like them. And so using technology, we built a platform, and the platform is Wealth Migrate. And in 2014, we did our first commercial building with investors. We raised $6 million from investors around the world. I think, I stand to be corrected, I think it was investors in 42 different countries. And we bought this building. We've subsequently exited this building. We've done a full life cycle with this building. And it really taught me a massive, massive lesson. Because what I realized after years of starting to be using both the technology and the platform and being in commercial property was that when I did an inventory or a balance sheet, whichever way you want to look at it, and I looked on the left-hand side, which was my residential properties, I realized that my residential properties, and remember, they weren't just in South Africa, they were in England, Australia, and America. When I looked at the residential properties, they were getting me lower returns with more hassle. And on the right-hand side of the fence, the properties, the commercial properties that we had on the platform were getting me higher returns with less hassle. So would you want low returns with high hassle or high returns with low hassle? Like, which one would you want? And it's not an emotional thing. It's purely a financial numbers thing. I was like, this is a no-brainer to me. So I started selling off the residential properties and taking that capital and investing it in the commercial properties. Because I don't know about you, but freedom to me is less hassle with higher returns in terms of where we're at. And today we're really excited to share with you where we're at. So that's been our personal journey, and really the story that I think you need to understand, and why I share that story with you, is because you've got the choice. You've got the choice of waiting and going through the pain that I've been through in the last 20 years. I've spent literally probably millions of dollars, but let's be conservative and say hundreds of thousands of dollars, and 20 years learning and studying from the best people around the world, both in the theory and in the practical. One of the things that I believe is one of my greatest gifts is that by helping lots of wealthy people invest and get wealthier, it's enabled me to spot the trends and the patterns. And I want to share with you one of the first secrets to wealth, and that's this, the theory of understanding the why. So when I look at all the investors that we've helped over the years, and you can actually see there on that video, it's members in 158 countries. In fact, we need to update that video because I got our latest stats for June just yesterday, and it's now 164 countries. But if I look at the patterns of 20 years, this is what investors are looking for in terms of their why. The first is preservation of wealth. I'm reading a book at the moment by Sir John Templeton, who was the greatest investor of the 20th century. And his number one investment strategy was diversification so that you could protect wealth. A second is a plan B. They know that to have all your eggs in one basket is crazy. And so it's about whether that means having all your money in one country, having all your money in one currency, having all your money in one asset class, or even having all your money with one partner. The third is peace of mind. How much can you put value on peace of mind and actually being able to know that you've got a sound strategy for you and your family? But the one that's most important to me is freedom. And why I say that is because what I'm passionate about is helping people get freedom. Whether that is where you want to live, where you want to send your children to school, where you want to go to university, or your children to university, I don't care. But what I do care about is that you've got the freedom to make those choices. And that for me is what it means to be a global citizen. That is the mindset. The mindset is of freedom. And so what I encourage you to do is that there's an idea that came out by Simon Sinek. And Simon basically said that most people in the world, if they're trying to do anything, they always try and start with the what and the how. What do I do? How do I get wealthy? What do I do to invest offshore? How do I buy a house in London? How do I get an international passport? What do I do? How do I do it? But what they don't realize is that unless they get clear on the why, in my opinion, and the research that Simon Sinek's done, you will never actually get to the outcome, because people get confused in the how and the what. So if I come to my board here, what we're going to do today is that most people start from the outside in. And what they're doing is they're getting it wrong. They have to start from the inside out. And so the first part of the equation is the why. And so what we're going to be focusing on today in the beginning is the why. So what I'd like you to do on the wealth plan, and if you haven't already downloaded this wealth plan, there should be a copy of it. But if you haven't, just take a piece of paper and a pen, and I'm going to open it up here for you. I'm going to put it on the screen so you can see it. And you can see here, I contract with my future self that I will implement my wealth plan so that I can experience these 5 benefits, the why, which are the most important to me. Now, I've learned one thing through all the courses and the books that I've been on, is that I'm sure none of you have ever been like this, but it's where I go on a course and I'm like, shit, that's really good theory. I should do that. But I get back into life and I don't do it. Or I go read a book and it's like, wow, that's a wonderful idea. I should do that. But then I get back into life and I don't do it. And so what I've learned is that there's nothing more valuable than doing it right now. Okay, so I encourage you to take 2 minutes, get a pen and a piece of paper. If you've got the wealth plan, great. If you just got a piece of scrap paper, it doesn't matter. And just write down, what are your top 5 whys? Why are you here? Why is this important to you? What is your future self, your future, in your case, your name, the Scott of 2030, the Scott in 10 years' time? What does it mean to you? Why is it important? Because if you get clear on your why, then we will be able to figure out your how and your what. So I'm going to put some music on, and you've got 2 minutes to do the exercise. I will read some of the questions in the meantime.
Your mouth is a revolver, find bullets in the sky. Your love is like a soldier, loyal till you die. And I've been looking at the stars for a long, long time. I've been putting out fires all my life. Everybody wants a flame, they don't want to get burned. And today is our time. Days like these lead to nights like this, lead to love like ours. You light the spark in my bonfire heart. People like us, we don't need that much. Just someone that starts the spark in our bonfire hearts. This world is getting colder, strangers passing by. No one offers you a shoulder, no one looks you in the eye. But I've been looking at you for a long, long time, just trying to break through, trying to make you mine. Everybody wants a flame, they don't want to get burned. Well, today is our time. Days like these lead to nights like this, lead to love like ours. You like a spark in my bonfire heart. People like us, we don't need that much. Just someone that starts the spark in our bonfire hearts. Our bonfire people like us, we don't need that much. Just someone that starts the spark in our bonfire hearts. Days like these lead to nights like this.
So I quite enjoyed the music myself, and but I wanted to just find out if you got enough time there to do it. I always find it tricky because there's stuff I want to share with you, and there's so much information to share. But equally for me, it's giving you the time to do this properly. And so I can't say it enough times. I really encourage you to take the time to really think it through as to what is your why and why is it important for you. So I implore you to actually fill in this wealth plan. Now, without further ado, I'm about to go into my personal why, and I want to share with you my why. But before I do, one of my partners, Gabriela Fares, is joining us. Now, the idea this morning is that I'm running the theoretical session, and then she's going to be taking us through the whole practical session. And so I just wanted to put a face to the name, and it's wonderful, Gabriela, to have you online this morning. She's the head of our revenue. She drives the entire team in terms of the objectives and us trying to deliver as much value to you. And I just wanted to put a face to the name, because I think what's really important is that while I'm giving people the theory, the nuts and bolts of what you're going to bring later with the practical is truly the value that people are going to get out of the session after the tea break.
Thanks so much for introducing me, Scott. Pleasure to be here. And I have to say, I'm loving the comments that I'm seeing in the chat from some of our attendees. And yeah, pleasure to be a part of this morning's session. So thank you.
Awesome. No, thanks very much. And Gabriela, I agree with you. You know, Susan has made a nice comment here. Originally, I was curious. What a great question. Originally, I was just curious, but now that you've asked, I find 5 very specific reasons that I have a direct impact on me and my clients by attending. Tony said, yes, plenty of time. Werner said, it's already so clear to me, but for the first time, I write it down. It's interesting, Werner, when you say that. And I know some people say this is an old wives' tale, but I love it anyway because of the theory. And I learned it first from Tony Robbins, where there was this Harvard study done, and don't quote me exactly on the stats, but it was like an MBA study when they were in 1960, and they wanted to see the impact of writing goals down. And it was something ridiculous, like when they came back 30 odd years later, the only thing they could really measure was money. And it was something like 30 years later, the people that hadn't written their goals down, that knew what they wanted, that didn't have goals. Okay, so let me get this clear. The people that had no goals, okay, like had less than 1% of the money. The people that had goals but hadn't written them down had the other 2% of the money. And the people that had goals and had written them down had 97% of the money. Now, let's say that that's slightly wrong. Let's say it's an old wives' tale. I think we can safely say that when you write it down, there's tremendous, tremendous power, which is why I encourage you to go and print the wealth plan. And again, just to remind everyone, I did put it in right at the top. And if you joined late, there is a resources page. And I'm just going to go to that resources page quickly just to remind you, because it's a link straight up to sign up to the platform. It's all our investor guides to be able to onboard. And then you've got the wealth plan here. So I'm going to put that just back in the chat room, just in case anyone has not got it. And because it's really important that you use the resources. And if you're watching the recording, the link is online.wealthmigrate.com/offshore-investor. So you can see it there. Okay, so let's go back to PowerPoint and let's rock and roll. So I asked you what your why is. I want to share with you quickly what my why is. So this was my dad and I. I was 13 years old working on that project. And my dad did what you were all taught to do. And I was taught to do. Let's go to school, go to university, work really hard, get a great job, trust the financial industry, invest, pay your taxes, and one day you will all be happy, healthy, and living in a great retirement. That's the dream I was sold. That's the dream my dad was sold. And yet, in 2005, on the 1st of August, my father passed away broke. He was 59 years old. And I, as a young man, went out and started looking at the research. And I've always had a fairly contrarian view to the world. And I looked at it and I was flabbergasted to find out that in the Western world, in England, Australia, and America, 94% of people at the age of 65 will statistically follow my father. They'll either be dead, broke, or reliant on the government. 5% of people will be financially independent. Now, that sounds quite good. Again, if we're in a live room, I'd say to you, put up your hand if you want to be financially independent. And just notice if you would like to put up your hand, because most people would. Until they find out that statistically, according to the financial industry, to be financially independent, you earn 25% less than your last paycheck. Now, I find that really interesting because I find that just 25% poorer. And quite frankly, the majority of people in the Western world that hit retirement are actually financially trapped. So they think they're financially independent, but they're actually financially trapped. And that's certainly not an outcome that I aspire to be. Which means that only 1% of people are retiring wealthy at the age of 65 with freedom. And I look at that and I go, that's wrong. Because there's 100 of us starting a race. And this is not about one person winning the race. This is 99% of people don't even finish the race. And that's why I believe the system is broken. So my why at a very young age was that I loved computers and I loved property. I loved the game of Monopoly. And I was like, well, why can't we use technology to make Monopoly a real life game? I also grew up in Africa where the wealth gap is in your face all day long. But I do challenge you, because when you look at the wealth gap, we talk about us and them. And when you look at these kind of stats, and the top 1% are getting wealthier consistently, and I tend to challenge people and I say, well, do you know why? And they're like, oh, because they got more time, they got more money. That's not the truth. It's because they invest in better quality assets. And where you're born in the world has a big impact on your wealth. Whether you're a male or a female has a big impact on your wealth. And even if you're a millennial, the timing of when you were born has a big impact on your wealth. But what I realized is that when I did the research and I looked that 49% of the world was held, 49% of the world's wealth was held in real estate. And yet only 12.9% of the world's population had access to real estate. And I'm one of them. And so are you. I'm willing to bet you that if you're on this webinar and you're watching this recording, you too have access to real estate, residential real estate. But what I realized was that I would put myself in us. So if we talk about the wealth gap, this only happened to me a couple of weeks ago when I was being interviewed in a press release. And I thought I was part of the us and I'll help them. But what I realized over the last 10 years was that I'm part of the them. And I'm definitely not part of the us, because the them are not investing like the us. And so for us, from a technology perspective, is that we wanted to use technology to help everyone to be able to invest like the top 1%. And so our philosophy of how we built the company was you can have anything you want in life if you help enough other people get what they want. So if you go back to that building in Wimbledon, I couldn't buy the whole building on my own. It was $10 million. I couldn't do it. But if I helped enough other people buy that building together with me, then I would not only help myself, but I would help all of them get what they want. Our vision was to make investing as simple as a swipe of a finger, and ultimately to make it where the investment amount gets down to as little as $1. And people say, well, why $1? And I always say $1 will not change your life. But if we can change your financial habits, we will change your financial destiny. And so why retail investors? And it's interesting because people tend to say, well, and again, us and them, the thems, no one cared about the thems, the smaller investor, but that's completely changing now all over the world. Kathy Wood, that's one of the most respected venture capitalists in the world, says, don't underestimate the little guy changing investing. Equity crowdfunding is making private markets public. We think that fractional investing represents the future. Retail investors used to always be wrong, says veteran Wall Street institutional trader Tiger Williams. Not anymore. Now you've got 50 million of them all tied together and they really matter. We collectively can actually do some great things now as investors together. And then why do we use technology? Why use platforms? Well, the key advantage of digital platforms is the ability to access more deals and invest smaller sums. Unlike REITs, these platforms allow people to invest in particular buildings. These platforms do more than provide access to institutional quality deals. They excel at disseminating critical information investors need. And so that's our why. That's why we do what we do. That's why we built Wealth Migrate. And this is the why of why most investors invest. Preservation of wealth, a plan B, peace of mind, and at some level, it's all of them equate to one word and one word only, and that's freedom. So let's go back to this quadrant. Whether you're a beginner in the investment space, whether you're an intermediate, or whether you're an advanced. And just by the way, I'm not only talking to the person that's starting with $100 and is 22 years old and is running, is in their first job. I'm also talking to the highly sophisticated investor that is worth hundreds of millions of rands, dollars, or any other currency, and is looking to diversify across the world and to become a global citizen. And that's why I talk about beginner, intermediate, and advanced, because each and every one of you, depending on where you are in your journey, has a goal. And that is what today is all about. And that is why we started with the why. Because when you get clear on your why, we can then get into the how and the what. And so it's time to go to the next circle. And that is the how. Hopefully you got clear on your why. Hopefully you understood my why or our company's why. Now it's time to get into the how. So there's 6 things investors need. The first is belief. So what does that mean? Well, as Henry Ford said, whether you think you can or you think you can't, you're right either way. And this is a really, really important concept, because we can tell you what the best investors are doing all over the world. But if you don't believe it's possible for yourself, then it will have no significance in your life whatsoever. If you do not have the belief, then nothing is possible. Now, just by the way, we've got the Wealth University, which I'll share with you later, that helps with the belief. So if you don't have the belief, there are great resources that we can share with you so that you too can have the belief, because the starting point is the belief. If you don't have the belief, you will not get there. The second is the knowledge. And what I love most is that in the old days, when I read this book, I went out and I read this book and I went on a course and I got a mentor and I got a coach. And quite frankly, I know people that took years and years before they bought their first property. And what I love now with technology is you can start and learn while doing. So never think that you have all the knowledge. You are going to have analysis paralysis in terms of trying to learn too much, because you can never learn everything. You have to be a leading learner. You have to consistently and ongoing learn. The third is access and investment. You know, you can have all the knowledge in the world, but you actually need to get involved and get access to good opportunities and start investing. The fourth is you need a system. The fifth is you need support and accountability. And the sixth is you need success. Now, what is success? It's different to different people. It's results, it's wealth, it's freedom, it's whatever it means to you. Now, when I first did this graph, I did it in a fairly linear fashion, and I realized that people were missing it, because what's really important is that once you get success, what do you think happens next? You start again. Because what's interesting is that if I use my mouse here, if you've got the belief and you invest, I don't care if you invest $100, $1,000, $1 million, you grow the knowledge, you invest, you have a system, you have support and accountability, and you get success, you're going to go on an upward spiral, because you're going to have more belief and you're going to be able to invest more and get more results. And it's an upward spiral. It goes up. What's interesting is if you do nothing, if you take today's theory and you walk away and do nothing, it's also a downward spiral. The belief, you won't have the belief, you'll take no results, you'll do no action, you'll get no results, which will reinforce your belief, and it'll be a downward spiral towards poverty, disappointment, and a lack of freedom. So these are the 6 steps that investors go through. And what I want to be very clear today is that this is not a get-rich-quick scheme. So if you want to get rich quick, the fastest way I've found is to go to the casino and to bet on red or black. Put your money down, and if you get it right, it'll double. And if you get it wrong, you'll lose it. We're not talking about that. We're inviting you on a journey that will take many, many years, and probably, in my case, similar to me, decades. And probably it's a journey for, not probably, definitely, it's a journey for the rest of your life. Now, I loved Monopoly as a young boy, and I learned through the game of Monopoly that it was about accumulating assets, and whether it was red hotels or green houses, it was all about the passive income that they paid me. And that's the invitation that we're inviting you on. There is no get-rich-quick scheme anywhere in the world. I include cryptocurrency, Bitcoin, anything you want. As fast as it can go up, it can go down. And long-term wealth is built by having good habits and by building up your passive income. So I want to start with a story, or share a story with you. It was 2009, and I'd grown my business, and I was already working as hard as I could. I couldn't work any harder. And I basically, they talk at the ceiling of complexity. I was hitting the ceiling of complexity. And so I spent a lot of money, about $50,000 to be exact. and I flew to Fiji. And this is me with Tony Robbins back in, I actually can't, no, it wasn't 2009, it was 2010. This is me in 2010. And I learned three major things from this experience. The first one is that with, sometimes you have to invest in yourself. Warren Buffett says the greatest investment you can make in the world is to invest in yourself. And by me investing in myself, flying first to Vegas and then to Fiji to do these business mastery courses just took me to a whole nother level. The second thing I learned was that I'd read hundreds of books on business, and I wasn't implementing what I was learning. I was getting the theory, but I wasn't implementing the practical. And so what I learned from Tony Robbins was that, repetition is the mother of skill. And it's interesting because if you go to this graph, basically, if we take investing as an example, most of you will be, here today, okay? And by learning some new skills, your skills will improve. But tomorrow you'll go back to real life and they'll fall off again. But you'll be at a higher level than where you were yesterday. And so congratulations. But how do you improve again? The only way to do it is through repetition. Okay, and you'll fall off again, but you'll be at a higher level. And how do you do it again? Repetition. And you'll fall off again, and you'll be at a higher level. Just imagine where you'd be at the end of this year if you were consistently working. And what about at the end of the next decade, over the next 10 years, if you were working on this consistently? And that was the lesson I learned from Tony Robbins. Stop going out and trying to find new fads or new ideas. Stop trying to trade in cryptocurrency and futures and the stock market and property and everything. Now, I'm not saying any one of those is wrong. What I am saying, though, and what I learned the hard way, is the principles of investment have fundamentals. Understand those fundamentals, copy them, and then you'll get the results. And the third lesson that I learned from Tony Robbins, which was the most valuable lesson I learned, is the fastest way to success is to copy successful people. The fastest way to wealth is to copy wealthy people. The fastest way to be a good business person is to copy successful business people. And what I realized was that, I didn't have to go and invent the whole new wheel. So I started 10 years ago studying the wealthiest people. I told you I'm reading a book right now on Sir John Templeton. What's their psychology? What's their mindset? How do they do it? Not only so I could share it with others, so that I could implement it in my own life. And what I realized over the last 10 years is I would take that a step further from what Tony Robbins said, because what he said was the fastest way to success was to copy successful people. I believe there's one extra level above that. The fastest way to success is to partner with successful people. Because if you partner with a successful person that's already done it, then you're not only going to learn while doing, but you're going to bring all of their track record to the table. And it was a massive, massive learning lesson. So when I ask people about the top 1%, and this was the latest research, I should probably look at it again because it's from 2017, but how much money do you need to be in the top 1% around the world? But what's interesting is I know plenty of people that are earning a lot more money than this metric of a top 1%. But I would still consider them not to be part of the top 1% because they're not investing like the top 1%. They're not following the fundamentals of investment, and thus they are not going to get the long-term results of the top 1%. It's a mindset, it's a fundamental, it's fundamentals, it's a philosophy, and it's a system. So let's go to some of those secrets. And there's another great book I recommend by Tony Robbins. It's called Unshakable. He went out during the last crash and interviewed 50 of the wealthiest people around the world. And what he's very good at is pattern recognition and synthesizing what these people are doing. So the first one is don't lose money. And it's interesting because Warren Buffett literally says rule number 1 is don't lose money. Rule number 2 is refer to rule number 1. It's pretty simple. Okay, so again, today, we're not talking about a get-rich-quick scheme. This is about preservation of capital. Secondly, asymmetric risk-reward. Now, I don't know if anyone wants to type in the chat box or give it a go. What does asymmetric risk-reward actually mean? So we've got a comment here, small investments with large outcomes, more reward, less risk. So thank you both to Cole, balance risk with reward, high reward, low risk. So well done to all of you that responded, really appreciate it. So the thing we're all taught in the financial world is the higher the reward, the higher the risk. The higher the risk, the higher the reward. That's what we always taught. And yet the wealthiest people in the world, it's the opposite. They look for high reward, low risk. The third thing is tax efficiency. And just by the way, we've got a partner in tax consulting that's going to be coming up after the tea break. I've been so impressed by the way that they've been assisting not only myself, but our clients. And no matter where you live in the world, tax efficiency is a personal, thing. And being tax efficient is highly, highly important. We also spend a lot of money on our structures to make sure that they are as tax efficient as possible. And so I saw a question here, is tax consulting coming? And yes, they are coming live later after the tea break. And then the fourth one is diversification. And this one I love the most, because the more I've researched this seems to be the overwhelming philosophy of the wealthiest investors in the world. And it's diversify across asset classes, diversify within asset classes, diversify across markets and currencies, and diversify across time. And what's interesting is that when I ask people these questions, I say to them, are you diversified? If you own 3 houses in South Africa, one in Joburg, one in Cape Town, and one in Durban, are you diversified? What about if you own houses in London, New York, and Sydney? Are you diversified? What about if you earn 50% of your money is in a REIT, a real estate investment trust, or a property fund, and 50% of your money is in the stock market? Are you diversified? So it's really interesting. A lot of people think that they are. And the challenge is that a property fund or a REIT has a higher than 70% correlation to the stock market. So you think you're investing in real estate, but you're actually not. You're investing in a financial instrument. And so what becomes quite important here is, what is diversification? So we all technically understand, don't have all your eggs in one basket. But what is it, and are we doing it? So there's a guy called Ray Dalio, and I would highly, highly recommend that you go and look up Ray Dalio. And he basically says, now he runs the largest hedge fund in the world. It's $160 billion. The minimum amount of money you needed to have to get into his hedge fund was $100 million cash. It's now closed. You can't even get into it. And he literally helps the wealthiest of the wealthy in the world make money. He's been doing it for 40 odd years, and he's the number one person that I respect the most. So go and read his book, Principles. Go and look him up on LinkedIn. He's actually published his entire next book on LinkedIn, and or even watch the webinar. If you're interested in the webinar, I did a webinar at the end of last year, or was it the beginning of this year? Sorry, I can't remember, where I synthesized all the information from him and what he recommended in terms of where the world's going. So if you want to synthesize it all within an hour and a half, then our inner circle, I presented to them my findings after researching all of his stuff. However, what he says is you need 15 uncorrelated bets in an attractive array of assets that don't move in tandem. That will reduce the risk by 80%, and the risk return ratio increases by a factor of 5. And ladies and gentlemen, that's all you need to do. I know the one lady needed to leave to go to work. That's fine. You can all leave now to get on with your day, because all you have to do is implement that. Now, if we were live in a room, what I would do is I'd ask you to turn to the left or turn to the right, the person on your left or right, and actually ask them, what does this mean? And it's obviously, I understand you're sitting in your own environment now, so we can't do that. So I want you just to take 10 or 20 seconds and just think about what you think that could mean. Just give it a go. 10 or 20 seconds. I'm going to have a quick drinks break. So Kathy said you have 15 uncorrelated assets in different unlinked asset classes. So yeah, Kathy, that's excellent. And what I think I'd like to point out to people just before I explain what I believe it means is that what often happens in the financial industry is that people make things sound very complicated so that we feel stupid. So if you felt stupid reading that, perfect. We all do. And I do it on purpose so that we don't trust ourselves and that we have to go off to our financial advisor and we can pay them fees to invest on our behalf. And I'm not saying there's anything wrong with financial advisors. I'm just pointing out the fact that the immediate reaction from the majority of people is that they don't trust themselves. The second thing is that I've learned when it comes to investing and finances is that actually it's a lot less complicated than you think. And often it's just common sense. And let me explain myself. What he's basically saying here is 15 uncorrelated bets. So that's, bets are investments, but uncorrelated just means they're not tied together. Okay, so like an investment in the London Stock Exchange and an investment in the New York Stock Exchange is very much tied together. If one market crashes, they all crash. In attractive assets, I mean, I think we understand what that is. It's an attractive asset that don't move in tandem. So again, you want to just make sure that if you're investing in houses in America, as an example, when the last crash happened in 2008, 2009, different states were affected in different ways, but the whole housing market moved in tandem. It might have gone up or down less or more, but it still all went down at the same time. And if you do that, so all he's literally saying is 15 investments that are not tied together in attractive investments. That's all he's saying. 15 quality investments that are not tied together. That's all he's saying. Okay. If you do that, you'll reduce your risk by 80% and you'll increase your risk return ratio by a factor of 5. So you reduce your risk by 80% and you increase your return by a factor of 5. So Rachel said, please explain attractive assets. So that's an interesting one because different people have different opinions of what an attractive asset is. And so Rachel, what my suggestion is that I'm going to talk now, I'm going to go into assets and different types of assets. And just to be clear, what I'm going to share with you is my opinion. It's not necessarily right. There are other assets that I don't invest in. Gabriella, as an example, was telling me that whiskey distillers claim that in the last 10 years, the best return on any asset has been whiskey. I can't tell you whether that's right or wrong. I have not invested in whiskey. So attractive assets are really down to individuals, but they do come back to fundamentals, and I'm going to share with you what the fundamentals are today. What I do think is really important, though, from Ray Dalio is that 10, 20 years ago, none of us, the majority of us that are on this call and the majority of people on the planet would not have been able to do this, because to go to London and to buy a property, just a single apartment or a house, took a significant amount of cash just to put down a deposit. To buy a house in the country you lived in was extremely difficult. To invest in the stock market, you needed significant money to, for a broker to take you seriously, et cetera, et cetera, et cetera. And now with technology, you can invest in, our platform from $100. You can invest in a stock market platform like Robinhood or Easy Equities from literally a couple of dollars. You can get involved in different asset classes now from far lower minimums. And, I don't believe that any of us have the luxury of an excuse anymore to say that we can't follow the investment strategies of literally the best people in the world. And so what I'm truly excited about when it comes to Ray Dalio's philosophy and Sir John Templeton and others is that you and I can literally copy them now. Now, just as a matter of interest, this is a report that we got about 3 weeks ago, and it's for a currency, and this currency is going to lose 50% of its value against a basket of goods. So against a basket of other currencies, this currency is going to lose 50% of its value, was predicted to lose 50% of its value over the next 5 years. Can anyone tell me which currency this is? So it's really interesting. A bunch of people have put there the rand, the US dollar. So as a gift, and maybe Shane, if you can, we could add this to the resources page, is as a gift to the people that are attending both the live breakfast and the virtual breakfast. We're going to share with you this report. It's a 3.5-page report on the US dollar and where the US dollar is expected to go against another group of currencies. Now, I want to be very clear. I invest a lot in America, and just in the last week, I've invested in two opportunities, which Gabriella is going to share with you. So I'm not saying don't invest in America, but what I am saying is make sure you're diversified, because what I've also invested in recently is in Portugal, in the euro. And what I think is very, very important is that we as global citizens with a global citizen mindset need to make sure that we don't have all our eggs in one basket. Be that China, be that India, be that South Africa, be that America, be that England, or be that Europe or Australia. That's what it means to be a global citizen. So let's look at the investment types. There's a number of different, and this comes back to Rachel's question. There's bank products, there's financial products, there's bonds, there's stocks, there's REITs funds or property syndication. There's real estate, residential, there's real estate commercial, and there's crypto. And I'm sure that if we kept going, there's 20 others we could, put in there, like fine art and fine wines and vintage cars, and could keep going. But what I want to focus on today is the ones that I've spent the last 20 years understanding, and the ones that we try and help people invest like the top 1% in. So I want to share with you another secret. And this, for me, was one of the most game-changing secrets that I found. And why I say that is because what I realized was that, again, you look at this big world, it looks hugely complicated. And actually, if you dumb it down, you get simplicity. And there's a great quote that goes something along the lines of, simplicity is the ultimate sophistication. And so please, whatever you do, when you look at how simple this is, don't belittle it and in your own mind it sounds too good to be true. Because just think about how important this simplicity is and what this will mean to you in your life. So if you take the property system, the real estate system, you and I are over here and we're trying to invest in an opportunity. And there's literally just middlemen all the way through. And each one of them is taking their fee. And I'm actually being quite kind here because there's 16 different middlemen between you and your investment. There's no trust, there's no transparency. And because of the high fees, there's low returns. That's the current system. Now, if you look at the value chain of real estate, no matter where you are in the world, there's 5 major steps. You've got land zoning, and that's where a developer goes out and they take farm fields and they convert the farm fields from what they call greenfield into brownfield. So it effectively gets planning permission so that you can actually build. Then you've got a developer that comes along and they build a vertical structure. They build a commercial building, they build a house, they build a block of apartments, they build an opportunity. Then comes an investor. Now, an investor is someone that actually wants to own that building and actually earn an income from that building. So whether it's residential or commercial, they want to earn an income. The next person or the next piece of the puzzle is the fund or the REIT. So once they've got stable income, then they sell that to a fund or a REIT. And then finally, you and I come along as investors. Now let's look at the returns. The average property developer or land developer is looking for an IRR, internal rate of return, of 30%. Now, if you don't know what IRR is, again, we've got a whole resources to help you understand these things. The property developer is looking for a 25% return. Now, again, they don't always get this, but this is their target return. An investor is looking for a target return of 20%. A fund or a REIT is looking at buying cash flow, which is between 5 to 8%. And again, that's in the first world, in America, England, Europe, Australia, that's probably even a little bit aggressive. And why they do that, when you invest in a pension, what are you looking for from a pension? You're looking for monthly income. You're looking for stable, predictable monthly income. And so that's why they buy stable, predictable monthly income. And then finally, you and I come along and we invest in a fund or a REIT, and we wonder why we battle to beat inflation. Now, there's an article on LinkedIn, on my LinkedIn, that you can go and look at this. And if one of the team members could post it in the chat box, that'd be great. Otherwise, I'll do it later during the tea break. But what's really interesting here is there's a whole article of how a company called the Billion Group built all these shopping centers, then tenanted them up, then sold them to a fund called Rebosis, who listed the opportunity and put it on the on the stock market for retail investors. And basically, the whole article is about the fact that the retail investors were overpaying for their investment. And what I find absolutely fascinating is that, having watched wealthy people invest in property for the last 20 plus years, the most money in property or real estate worldwide is made when people sell to a fund or a REIT. That is the major way that they make money. And so it's really, really interesting how this concept works. And so if you understand this value chain of real estate, my question is, why would you not cut out the middleman and go directly and buy a big commercial property, and or develop it yourself, if you understood the value chain of real estate? And I tend to use the metaphor, I travel a lot. And, before Uber, I would get to an airport, I'd take out my phone, I'd phone a taxi owners association, who would phone a taxi owner, who would phone a taxi driver. And that taxi, would come and pick me up and take me from A to B. And if I didn't know where I was going, they'd probably take me the long way. They would overcharge me. And if I ever left my cell phone in the car, I'd never, ever see it again. And it's quite interesting because here's a picture of one of my colleagues who left his phone in the car on one of our trips. And this was the driver, delivering it back. Funny enough, the same thing happened to me just last week or 2 weeks ago in Joburg. I left my earpods in the car and it came back to me. So what did technology do? Well, it cut out the middleman, it cut the costs, and it dramatically increased the trust, the transparency, and the accessibility. We've now all got access to our own private driver. And so if you go back to the value chain of real estate, I say to people, well, just like we've learned from Uber, why don't we cut out the middleman? Why don't we move up the value chain of real estate? And what's really interesting is that these are the answers that people all over the world have given me. It's, how do I protect myself? It sounds too good to be true. I don't have access to deals and partners. There's too many scams. I don't know how. There's too much compliance. It's too difficult to invest offshore. How do I manage the ongoing management? It's too complicated, time and effort. I need the right structures. I don't have time. Local real estate is too much hassle, etc., etc., etc. And so let's look at the principles of investing quickly. There's 8 principles that you need to know. The first is that you need to understand the macro and microeconomic factors of a country. The second is you need to understand the location of the property, where it's situated. What due diligence has been done? Every single opportunity you invest in should have done due diligence. Fourth is the risks. What are the risks? What's really interesting, people believe that investing has no risk. Even putting your money in the bank has risks. So understand that there's risks, and how do you manage those risks? Choosing the right partners, tax, compliance, bank accounts, and structures, managing your asset, or in financial language, they call it sweating the asset, and ultimately understanding the exit. These are the 8 things these are the principles that investors need to know. Let's look at some of the mistakes. So the first mistake that investors make is they make crisis investments. The Rand halves, or the finance minister gets fired, and they go, oh, we're in major issue, and they literally invest, and they try and make a crisis investment. And what's really interesting to me is that I find it absolutely fascinating. When the Rand is at 20 Rand to the dollar, our phones are ringing off the hook. When the Rand, like it is at the moment, gets to 13.50 to the dollar, silence. The Rand is going to get better. That's a classic example of crisis investing. They don't get the right information. A good story here was, there was a person selling properties, American properties, to overseas investors, South Africans, British, Irish. And what was really interesting is that they would in the same street, if your house was on the right-hand side of the street, your kids could go to a good school. And if it was on the left-hand side of the street, it was the worst schooling district, the third worst schooling district in the whole of America. And what was interesting is that you and I, as international investors, we don't know that. The houses just look the same. Even if we go online, we look at the values and we think, geez, our house is so much more affordable than the one over the road. And yet that's a classic example of not having the right information. The wrong partners, hopefully that goes without saying. I always believe that people believe that they're investing in property. You're not. You're investing in partners. You're investing in people. They don't understand the cash flow and the management. They don't understand the whole complexity of local versus international. If you want to be a global citizen, you have to think like a global citizen, and you have to play with people that have the ability to be global citizens. They underestimate the sales and the costs. And then one that I've learned the hard way myself over the last 10 years is where you buy off plan, and sorry, probably 15 years now, where you buy off plan, you think you're going to make all this money, and there are a whole lot of risks that you're not in control of, and it's a very, very dangerous way of investing. The last mistake that people make is they don't take into account technology. And it's interesting because, literally retail centers, and this was before COVID, were going bankrupt all over America. I brought this article out last year before COVID about this massive company in the UK that owns 8 of the biggest shopping centers in the UK, and how it had lost 30% of its value. It was about to go bankrupt in March last year. So this is even before COVID. I mean, who knows? In fact, I should go and do the research as to where they're at now post-COVID. And what's interesting is that, some of the investors in that company are Coronation, the PIC, Sanlam, Investec, Old Mutual, Stanlib, PSG. So I tend to always say, all you need to do to be able to trust someone is if they can put an ad in the airport. And then, one of the comments I saw earlier was commercial properties changing. People are working from home, etc. So you need to make sure that you've got strategies in place. And we're going to talk about office because I think it's a great opportunity at the moment, but it has to be done in the right way. And you can't just what worked for the last 10 or 20 years is not going to work for the next 10 or 20 years, including people taking their yoga courses online and everything in between. So money won't create success. The freedom to make it will, said by the great man, Nelson Mandela. And that's what we've really tried to implore. And so what we do as a company is that we provide 2 opportunities. We provide an income opportunity, which is exactly like this house. It exists and someone is paying a rent for this house. Okay. In this case, it happens to be me. But if we were in an office or a commercial building or an industrial building, someone is actually paying for that property and it's earning an income on a monthly or quarterly basis. And then you've got a growth, which is a new development, which is where you're building a new development, but you're going up the value chain of real estate. You're cutting out the middlemen, you're cutting the costs, and you're dramatically increasing the trust, the transparency, and the accessibility. Now, let's just look at some of those risks. If you take a growth opportunity, they tend to be higher in risk. And the reason being is that they're things that are out of the developer's control. What will the markets look like in a year or two's time? Building costs can go up, timeframes can extend. So you tend to put your money in and then you get a return, you get your capital back plus a return only when the project finishes. And so a lot has to do with the timing of when that project finishes. And that actually remains out of the control of even the developer because things like COVID can happen in the market. On an income opportunity, you've got an existing opportunity. It's an existing building. You can manage the variables much easier. There's still risk. Your tenant can still default and they don't pay the income. And so one of the things that you want to look at is what's the quality of the tenant? How predictable is the income? How stable is the tenant? Can you fix your mortgages so that your interest rate can't go up, etc. And these are things that from a risk perspective and for the purpose of today, we've got courses on this where you can literally go into the detail and understand all these risks so that you can understand them better. I'm just giving you a high-level flyover. Now, one thing that I didn't actually have in, and a lot of people asked me, was what's the difference between residential and commercial real estate? So here's a very simple little graph. In simple terms, you've got residential, you've got commercial. In residential, it's easy to get started. Yes. Commercial, no. The experience to get involved in residential is little, whereas in commercial, it's lots unless you have good quality partners. The deposit in residential is often 10 to 20%. In commercial, it's 30 to 50%. In residential, the leases are 1 year, whereas in commercial, they can be 3 to 20 years. In the maintenance in residential, you, the owner, have to look out. If you've ever heard of fixing bloody broken toilets and all that, that's because that's what you have to do. Whereas in commercial, it's the tenant. You don't have to do anything. That's why it's hassle-free. The legals, who's protected. So even though you own the house, you can't kick the tenant out. They're the ones protected. In commercial property, it's the owner that is protected. The hassle is much higher in residential. It's much lower in commercial. The risk is much higher in residential. It's much lower in commercial if you know and are partnering with the right partners. And what is the exit? It's to a homeowner or an investor. And in commercial, it's to an institution. So again, we've got a whole course just on this. Now, the question you ask yourself is, how do you manage and protect yourself? How do you manage risk and protect yourself? So I think there's only two important things. The first is that you get the right information. And the second is you get the right partners. So what we endeavor on our platform is to provide investors with the right information so that you can make educated and informed decisions for yourself, and to provide you with the best partners, world-class partners. And I believe that if you've got those two things, you're going to dramatically reduce your risk and give you a way to manage it. So Gabriella's going to go through this after the tea break, but on our platform, we've got a whole system of how we show people what we believe is the risk, both for our partners and for the deals, so that it becomes easy for you to analyze an apple with an orange or banana, and you can start to understand how risk actually works. And as I said, Gabriella is going to go into that after the tea break. Just in terms of local versus offshore, what's really interesting is that now is a good time to be investing. There's low asset values. There's, COVID has provided a lot of opportunities. There's strong local currencies. If you're strategic, you can really set yourself up, rather than being crisis, like I explained earlier. You can control the variables. You can unlock, with capital, you can unlock opportunities. And more importantly, with all of us coming together, we can unlock more opportunities, and we can use our offshore allowances. And I know this is a very rudimentary graph on the right here, but in simple terms, if I look at the last 20 years, I started investing in 1999, so it's been 22 years. The costs of the assets have gone up, and my buying power in rands has gone down. And that graph, those jaws are just getting wider and wider. So in terms of the mistakes people make, I have mentioned a number of them. We do have 3 white papers, one for the beginner, one for the intermediate, and one for the advanced. I don't care whether you invest with us or not. What I do care about is you not making mistakes. And I highly recommend that you get access to these white papers and read them. How do the top 1% understand risk and manage them? So again, a personal story. We had the crash of 2008, and you remember all these, the world was exploding. Lehman Brothers was going bankrupt. And I remember talking to my uncle. Now, my uncle's a very successful stockbroker. He's taught me a lot about making money and investing. And I said to him, what are you doing? And I mean, he was worried about his money being in Barclays Bank, because Barclays Bank was on the verge of going bankrupt. In fact, it was worth less than ABSA at the time. And he said, no, well, he's investing in Coca-Cola. And I said, why Coca-Cola? And he said, well, they're in over 100 countries. They've got complete diversity of products and of income streams, and they pay very good dividends. They pay lots of income. And I remember thinking, wow, that's absolutely fascinating. A couple of years later, I read a book called Snowball, and it was the life of Warren Buffett. And I subsequently found out Warren Buffett owns something like 15% of Coca-Cola, and for the exact same reason, because it's got predictable income. I then looked at my own personal story, and back in 2002, I bought this house. I told you already, it was a 3-bedroom house in Wimbledon, in England, in London. And at the time, we just had September the 11th. England was going to war with Afghanistan. Oil prices were expected to go up. Inflation was expected to go up. Interest rates were expected to go up. But I remember saying to my friend, well, why don't we just put a conservatory onto the property? We can turn a 3-bedroom house into a 5-bedroom house. And by doing that, we can have a lot of income, a lot more income than our expenses, which provides us with a buffer. And so we bought the property and we made the investment. And what was interesting is that that never really happened. But in 2008, 2009, when we had the crash, interest rates plummeted and our gap just got even bigger. And what I learned through the last crash was that the most successful people invest for income. The middle class and professionals invest for capital growth, and the wealthy invest for income. Because if you've got predictable income, that is true wealth, because you can ride through any storm. And I learned it myself with this property. I then learned it with medical buildings, where when I was asking around America about investing in medical buildings, and I said, how did you perform in 2008, 2009, 2010, when the residential market was being devastated? They said they didn't lose one single tenant. And on that basis, who cares what happened to the capital values, because that predictable income continued to come in each and every month or quarter. And what's interesting is that the best performing asset class in the last 10 years in America has both been multifamily and medical, because of their predictable, sustainable income. So how do you manage risk? You focus on predictable income. And then when you look at value, most people tend to, in a crisis, we're in the middle of COVID, and they tend to say, oh, we've had this crash, but you actually need to look at cycles. You need to look at fundamentals. And a great example of that is that in 2009, there was an opportunity in Greenwich in London where the developer was offering a 26% discount. And we bought about 30 units in that building. One of those clients, a gentleman called Don, actually bought 4 of those units for about between 300 and 400,000 pounds each. And he told me he sold all 4 of them for more than 1.2 million pounds 10 years later. So that's the example of focusing on fundamentals. Another example that Gabriella is going to talk to you about is office space. So right now with COVID and people's thinking is that people are moving away from office. And so you can get actually really good bargains. But what's the long-term future? As an example, we got an opportunity that I've personally just invested in Fort Lauderdale, which is down in Florida. And everyone's moving from New York, Chicago, etc., to Florida because it's warm, it's sunny, it's a much better lifestyle, it's lower tax, etc., etc. Now, Fort Lauderdale is one of the wealthiest places in America. And they've got an A-class building, which we'll share with you later, and it's a co-working space. But they're buying buildings at a discount, and you're dealing with a partner that's been in this game for over 100 years. And I think that, is a good example of being anti-cyclical and picking up good opportunities. So as a global focus, you can choose to invest with a local partner in the Seychelles, or partners in America, or partners in England, partners in Dubai, Asia, etc. But the problem is that if you want to be diversified, you're going to have to be on all their different platforms. Or you can be on one platform, Wealth Migrate. You can deal with the best partners in the world, the best opportunities. You can have your money managed by your digital wallets, which are protected in Europe by Lemonway. And Gabriella will go into that in more detail. And you can be truly diversified and protected. So from our perspective, to finish off with the how, we started with $100,000 minimum investment. We got it to 10, we got it to 1,000, and we now are beta testing people being able to invest even from $100. So, hopefully we're explaining to you how it actually works, because we go out and we find the best partners around the world. They literally list their opportunities on the platform. You and I get access to those opportunities. And there's 4 simple steps. We sign up, we complete our profile, we fund our wallet, and then we invest and manage our global portfolio. And what I'm truly excited about after the tea break is where Gabriella is going to go in and show you this live. There's nothing more powerful than actually seeing this live compared to learning about this in theory. So in terms of our product range, who do we help? And depending on who you are sitting in the room, you can see here that in terms of the wealth, we've got Wealth Create, we've got Wealth Migrate, and we've got Private Wealth. So in very simple terms, we have not launched Wealth Create yet, but when we do, That'll be for the hustler, the employee, the student, the person that's wanting to get started, basically. And I'm not going to spend too much time. This might resonate with people. We have not launched this yet. Wealth Migrate is who we focused on for the last 7 years. And it's entrepreneurs, it's doctors, it's farmers, it's consultants, it's self-employed people. They're looking for something that's easy and simple. They want it to be safe. They're not interested in lawyers and bank accounts and hassles and structure. They just want it to be easy. They want to be in control and make their own decisions. They want diversification, both local and international. They are happy to pay transaction fees. You know, when I caught my Uber, I know that I'm paying a fee to catch my Uber, but they don't want to pay assets under management. So what does that mean? Well, if you use Airbnb as an example, you know, I Airbnb my house here in Knysna in South Africa. And before COVID, we used to make good money out of it. Since COVID, we've had like one guest, I think it is. And yet I haven't been charged a management fee by Airbnb. They only make money when I make money or when they make me money. And that's what a transaction fee is. The traditional model in the financial industry is an asset under management fee, where they make a fee, whether they make you money or whether they don't make you money. And the new way of where the world's going is it's all about transaction fees. We only succeed when you succeed. It's automated and mobile, and it's online. And then something we launched in February is our Private Wealth Global, which is for investors that are investing $100,000 or more. And this tends to be business owners. They're sophisticated. They're looking to preserve wealth. They're wanting first world citizenship. They're used to the family office concept. They want diversification across global and other alternative investments. They want a variety of financial products. They prefer transaction fees, but they are happy to pay assets under management if they're getting massive value. They want it online, and they want it to be generational wealth. And so depending on which resonates with you, our team can help you. And the way that I see it is that when I fly to London on an airplane, you've got economy class, you've got business class, and you've got first class. You know, Wealth Create is economy class, Wealth Migrate is business class, and Private Wealth Global is first class. So whether you want to invest in America, England, Europe, Australia, or South Africa, you no longer need to choose. And whether you want to invest with partners in medical, industrial, office, multifamily, or even game reserves we've had on our platform, you don't have to choose anymore. We go out and we find the best partners. And just by the way, we're not finding thousands of partners. Our due diligence team is aiming to bring on 15 world-class partners around the world. And if they are bringing 3 to 4 deals a year out of England, Australia, America, and Europe, that's 60 deals a year. That's more than 1 deal a week. That is ample variety and diversity in terms of what we're achieving. So it's not about quantity, it's about quality. And then in terms of our due diligence, the foundations of this started many, many years ago. There was a gentleman called Clem Sunter that wrote a book, The Mind of the Fox. He's one of the most recognized scenario planners around the world. I took his scenario planning and I built a 4-dimensional model. And he was so impressed by it that he said he would endorse the book Property Going Global. So if you'd like a copy of that book, we can also share it with you. It's a little bit old now, came out in 2014, but it was the basis upon how we did our due diligence. It evolved into GIDS, Global Investment Due Diligence System, number 1, which was residential, and then GIDS 2.0, which became commercial. And Gabriella is going to go into in a lot more detail after the tea break of how that due diligence takes place. So when we look at our track record, you know, we've now got members in 164 countries. We've got investors in 66 countries. We've done over $630 million of value in deals. And we've had investors invest over $100 million through the platform. We've paid out millions of dollars in dividends. And you can see here that the average investment size is about $33,000. So, you know, I tend to talk about the $1,000 investor. We've had many, many people invest more than $1 million. And the average is about $33,000 per investor. And then we've done the how, and now it's time to finish off with the what. And if I go to the final circle, we got the what. Hopefully you're enjoying my little picture behind me so that it's making sense to you. So what do you do on the platform? Well, we're going to be going through that after the tea break. So Gabriella is going to be going into a lot of detail of how the platform works and what do you do, how and the what. The whole point of this morning's session was to give you the theory on the why and to explain the how and the what theoretically so that you can practically get involved. Now, before we go to the tea break, I just want to give you some peace of mind. And I want to show you our performance. So if you go back to that very first medical deal, it paid out over 9% cash on cash for 5 years in a row in US dollars. And this was, a highly successful investment opportunity that we did with SG Properties on the ground in Atlanta. Medical 2 actually paid out as much as 10% cash on cash in America as well. And we then took those 2 deals and we bundled them together and we sold them to a fund back in 2019. So just as I've been explaining to the whole value chain of real estate. It doesn't always work. And so if I was sitting here and telling you that every deal works 100%, it doesn't. This was a deal in Australia, in Brisbane, that was meant to be a new development. The Chinese government changed the rules on people being able to, take money out of China. And because of that, Australia changed the rules on foreigners being able to invest. And we found ourselves with a big 4-story hole in the ground. And we've now repurposed that into a co-living space. And it's actually it's a new opportunity that is being launched as we speak. And what's interesting for me as an investor, I'm an investor along with 82 other investors, is that I haven't lost any capital, but I have lost time. And so like I always say to people, it's not how you behave when it's working, it's how you behave when it's not working that counts. And that's why the caliber of our partners is so important. It's also why I say to people, if you've got $100,000, pounds, euros, and you go and buy a house, and that's probably only going to be enough if you buy a house in London for a deposit, and your one tenant doesn't pay you, you've got significant risk. But if you took that same $100,000 and invested $10,000 in 10 different buildings with 10 different partners in 10 different opportunities, then you've got you're lowering the risk dramatically. I mean, the chances of 1 or 2 of them paying you might happen, but all 10 of them at the same time is never going to happen. And so you've got much lower risk with much better diversification, much better upside, and also a lot less hassle. So, these are just some of the buildings that we've done. This was in Atlanta. This was in Texas. This was not just an apartment in London, but the entire building. This was an industrial opportunity in Australia. Sorry, that was in London. This was in Australia. And this was even in South Africa. And something that I get asked all the time was how fees impact. And so if you look at that same book I told you about from Tony Robbins, 1% of fees equal 10 years of your retirement income. It's a significant amount. And what a lot of us do is we give our power away to other people. And yet, if you look at the research over the last 15 years, 96% of fund managers don't even beat the market. Okay, so in terms of long-term trends, this is why index funds and investing in direct assets is going to make you a much better return long-term, because you're not being drilled by fees, assets under management every single year. How do we make money? And I've already explained the Airbnb model to you. It's exactly the same as Airbnb. We charge a transaction fee up front. It's 3%, 1% for the platform, 1% for structuring, and 1% for investor acquisition and marketing. And then we have a profit share only after you make money. So it's 10%, but I want to be clear here, this is only after you get your capital back. So it actually, in a percentage term, is far less than the fees that you would pay under the traditional model. And we're only succeeding after you're succeeding. So it's making us aligned to your results. If we were just earning fees, whether you were succeeding or not, that is the old way of doing it. The new way of doing it, again, copying the likes of Airbnb, is we only make money after you make money. Is it safe? Well, this is quite an important one. And Gabriella is going to go into our partners. But I think there's 3 things I say to people when they ask me this question. The first is that your money is separate from us. So it's in a company called Lemonway. They're the biggest payment service provider in Europe. They're protected by European regulation, and they're also backed by the top 5 banks in Europe. And that, gives me significant comfort because the money is separated from our platform. Secondly, every deal is ring-fenced. So unlike a property fund or a REIT, you can't rob Peter to pay Paul. You don't have blended returns. They're completely ring-fenced, so you don't have any risk between one deal to the other. And the third one is that we are a regulated entity, and so we have to comply by regulation and compliance, which is very stringent. But even if we were to go bankrupt, we don't actually own your money or the asset. Okay, the money is still independent of us. And so although it would be a hassle if we were to disappear, your money is not tied up in our company. And it's one of the reasons why, from a regulatory fiduciary perspective, it's so important to keep those separate. How do you manage tax structures, bank accounts, and processes? If anyone has been with me for the last decade or more, you'd know we were flying to America, we were buying houses in America, we were setting up LLCs, companies, we were opening bank accounts. It was an absolute logistical nightmare that me and all the investors have been trying to unwind. Now on the platform, you don't have any of that. All the structuring is taken care of, all the tax is taken care of at the investment level, obviously not your individual level. You don't have to set up bank accounts. We've got the digital wallet. It's all taken care of for you. And that's why we say it's so safe and simple for people to be able to participate. And then I get asked the question all the time about global citizenship. And we do help people. As I said to you, within Private Wealth Global, we've helped many people immigrate to America, to Australia, and to Europe. And so it is a possibility. We don't do it ourselves. We've got partners that can help and facilitate that. But I truly believe, as a global citizen, the most important thing, and here's just an example of a gentleman, Martin Freeman, that we originally took on buyer's trips and helped him buy houses in America, and then we helped him get involved in commercial medical deals, and ultimately we helped him get his EB-5 to immigrate to America. So it's certainly possible, but I believe as a global citizen, we all have the ability to be global citizens by starting to invest. Because when you're earning first world assets with a first world income, it truly gives you the freedom to make these decisions in time as to where you want to invest and how you want to invest. And so I want to finish off with a bit of a gift just before we go into the tea break. And that's what we call the wealth plan. And one of the feedback that I've been given from a number of people is that when I try and teach people in these webinars, it's like drinking from a fire hose. It's so much information, and it can be overwhelming. And I apologize for that. I get excited, I'm passionate, and I'm trying to download with you what I've learned in the last literally 2 to 3 decades. But what we did is we put together a wealth plan. And my colleague Shane was the one that deserves the credit here, because he said, well, if you take this book, Rich Dad, Poor Dad, and I mean, it's 200 and something pages long. I actually don't know how long it is, 200 pages. And if you could do it in less than 60 minutes, how would you be able to make it simple for someone so that they could just get started? And so this comes back to the whole portfolio strategy. Einstein says compound interest is the 8th wonder of the world. If you started, the earlier you start, the better you'll be in life. We know all this stuff. But what we've done in the wealth plan is we've shared the concepts that I learned myself. And why did I learn them? I don't know. I wanted to understand how the fundamentals of investing worked. And I shared this example before where my son, I wanted him to be able to go to university. And so I went and did the maths, and by the way, any university in the world, Harvard, Stanford, whatever. I did the maths. How much would I have to invest per month, at what return and what time scale, to be able to give me the freedom to make that choice? So remember, I got clear on my why, and then I started to focus on my how and my what. And so this was my why, my son, and one day, giving him the freedom. Now, whether he wants to go to university or not, that's a whole separate conversation. But I want to be able to have the freedom to be able to make that choice. And so I went and did the maths. And what we share with you in the 4-step formula is actually how to do it. So within 60 minutes, you too can build your own wealth plan where you can move. So again, from this, you can move from being an employee or self-employed to literally as quickly, simply, safely, and predictably as possible without being trapped by the financial industry, scammed, or giving your power away to anyone else. And basically without having any additional stress or hassle. So that was the concept of the wealth plan. Shane set me a challenge and said, could you do this in 60 minutes? And we literally built it. And it's interesting because that statement that I made earlier, simplicity is the ultimate sophistication, is that it takes 2 decades worth of learning and knowledge and synthesizes it into 60 minutes so that you too can get started and have your plan. And so there's a bunch of steps. The first thing is that you literally watch the recording. It's the whole thing, including doing your own work, is less than 60 minutes. You've got a freedom calculator. So this is the freedom calculator here, where you literally go in and you can put in how much money do you want per month. What is the net cash flow? Because that'll give you an average amount, and then ultimately a total capital required. So you can put this, and you can say, I want $1,000 a month as my, that's what I believe will provide the freedom I want in my life. It's an interactive calculator. I'm going to go back to 15,000 because I believe that's the passive income of a global citizen. And then you can go and play around. If it was $100 a month that you were investing and you left your money in the bank and it was a 20-year term, would you be free or not? And if it's in red, you're not free. You're only free if it's black. Okay, and you can see it's the after tax. Okay, well, if I do $500 a month, okay, if I have a 6% growth rate, a 15% growth rate, a 20%, am I free? Nope, I'm not free. If I do $1,000 a month, am I free? And I can literally go in, you can see I'm nearly free here at $1,000. And if I do $2,000 a month, am I free or not? And you can see that you then are free. So what's really interesting is that it's a calculator. You can play around with it. And what I also did was I created a graph, because most people aren't going to put in the same amount of money each and every year. So what I said was, well, if you start with $100 and you give yourself 20 years and you aim for a 15% growth, could you get to $15,000 in 20 years? So I'm 44 years old. That means I would be 64 years old if I was starting from scratch. And I actually proved to people that you can do it. So I've given you the plan on how you can do it. And then finally, you get your wealth plan. And if you remember back to the wealth plan here that we've already shared with you, it really gives you then the simplicity to be able to fill this in, because you now have the how and the what. What is your amount that you want per month? What is the average cash flow return? How much am I committing to put in my wallet every month? What is the target return and how many years? And then when I follow my wealth plan, I'll be free by this year at this age, earning this much, and I commit to start on this date. And then you sign it. So you put your name, you sign it, and you have a witness. And I'd suggest you put it on your wall to hold yourself accountable. And by the way, your freedom calculator gives you the information basically. So if I go back to it here, what we've tried to do all of today is give you the tools. We started with the why, remember, and now we're going to the how and the what. It'll also give you the wealth plan, which you should already have because you're on this breakfast. Then you've got the investor test. So what's really interesting to me is that something that I'm really excited about is that we built this investor test a while ago. So if you go to the Wealth University, you can log into the Wealth University now. You can look at your activity feed. You can go to your different groups, and you can actually sign up to different groups and what you want, life hacks and digital real estate, etc. And you can also do your content and your courses. And here you can see the 4-step wealth formula in terms of it. And there's a whole bunch of courses and stuff that you can actually go in and do. When you get to the investor test, it's basically a test that you do. Now, you can't pass or fail this test. It just helps you know where you're at. And you've got the why, the what, the who, the when, and the how. And it gives you your results. So it's a completely interactive graph. You can see the life cycle of a real estate investor, the wealth spectrum, which I learned from Roger Hamilton. You've got the amount of passive income, and you've got your freedom fund. And it'll give you the different, your different weightings as to where you're at. And you can go and read all about it. There's a whole bunch of information here. And you can then go and read about your why. You can read about your what. You can read about your who. you can read about your when, and you can read about your how. So that's all the theory. But what most people are interested in is what's the practical example. And so if you go to your purpose, this is now completely interactive. And depending on where you are, it literally tells you what to do next. So if you go in, and it'll literally tell you, depending on your level, what you should do. So at your purpose quotient, your investor quotient, it literally tells you what to do next. So it's a completely interactive way to help you, depending on where you are. It's a personalized path to wealth. And I'm really, really proud of what Shane has built here for all the investors, because the feedback we were given people is that it's overwhelming, Scott. There's so much information. Where do I start? And now you can get access. And there's a question here, how do we get access to the calculator? We're going to be following up, Aubrey, with the different links. It is on the resources page as well for people. And then finally, the ability for people to join the Wealth Hackers community, which is where, I love the story when I met with Richard Branson on Necker Island. And basically, there were 25 of us, and our only homework was we had to arrive with one thing that we'd figured out a way to make life easier, to hack life. And I learned that was such an incredible thing, because along with Richard Branson and these 25 other amazing people, I learned like so many incredible new skills. And so our Wealth Hackers community is the same thing. Like, we're all hacking our way to wealth. Why don't we just do it together? So that's the investor test. And as I said, I've shown with you where you can go and read all about it. And the 4-step wealth formula, there is a link here where you can get started. I will share the page. It is brand new. It's literally, just literally getting started, so that people can go in and get access to the opportunities. Now, today is not about that necessarily, because today is a holistic overview of everything. But what I wanted to share with you is that, there's different steps. Now, on next week, I think, next week, Wednesday, I'm doing a webinar with a gentleman called Mark, and it's all around portfolio planning. Now, I just wanted to share this as an insight, because Mark is an amazing person. I've met him through a global community that I'm part of, and it's all about balancing and building balanced portfolios. Now, I'm not going to sit here and try and sound like an expert, because I'm not, but ultimately you want to be building your balanced portfolio between different asset classes, of which real estate is a primary one. And so I highly recommend that you're part of that. And if you're watching the recording, make sure that you get the recording to watch that. But these are the value adds that we add to our community on an ongoing basis. So we're learning from the best in the world. We're copying what they're doing, and we're also partnering with what they're doing. And then, to finish off, there's so many success stories. I don't want to go into a huge amount of detail, but people like Chad Pope started investing back in Australia in 2012. He's a successful business person. He managed to get diversification of income. He then started investing in America, and ultimately he brought structured notes, which Gabrielle is going to talk about after the tea break, a whole new business stream to our platform, which we're really excited and grateful for. Gert de Pree started investing in America in 2012 and has built up a really nice passive income that's diversified across many different asset classes. Rolene and Ian Powell started investing in America, but actually live in Australia, and they thought that they could get a better return in America, but they chose to immigrate and live in Australia. Michael and Lee Honeysett wanted to build passive income for their daughters, so that they could provide freedom for their daughters, which they achieved. Hilda Lunderstedt actually invested in commercial real estate about 8 years ago. That enabled her to go on holidays to Necker Island with Richard Branson. And equally, her investments ultimately helped her immigrate to America. She's currently living in Texas. These gentlemen, Alan Kynock, Henny Besaidenout, Michiel Lucas, all basically traveled to America with me originally and started investing in commercial assets, and particularly in the medical space, and have now managed to build up a global diversified income and represent that global citizenship. And then, someone like Dirk wanted to do it for his son so that his son could go and do motocross in America one day, again, freedom, which he was able to do. Ricky Jack was a youngster. He wanted to be able to go live in America one day, but he wanted to learn and do, and he subsequently did that. And even this gentleman, Jaco, who wanted his son to have the freedom of being able to go to any university. And by starting to invest back in 2013, 2014, it enabled him the freedom to allow his son to go overseas on a golf scholarship and travel overseas. So everyone has different reasons for their why. But one of the things that I'm most grateful for is that over the many years, we've been able to facilitate and help people actually do that. And so what are you doing to become a global citizen? And are you ready for our digital decade? I'll remind you of how we started off. There's 6 things that investors need. The first is the belief. The second is the knowledge. And if you're wanting to increase your belief and your knowledge, we've got the Wealth University. I've shared with you the Wealth University. I'll share with you the link, because that's how we cover both the belief and the knowledge is all within the Wealth University. We've got the course in terms of how you can build your wealth plan, get started, and to be able to use your freedom calculator. Then it's about the platform. It's about accessing and investing. It's about the systems that are on the platform and how you actually use them. It's about support and accountability. One of the things that I find greatest is being part of a community so that I am accountable to that community, but we also support each other, and we're all learning and hacking and finding out ways and getting access to knowledge, what works, what doesn't work. And then ultimately it's about getting results. And that's why our team is here. And, you know, we highly recommend speaking to our team, because they can give you that support and that accountability. And then ultimately, as I said, it's about the results. And remember, it's an ongoing upward spiral on a journey. And so as we go into the tea break, I think what's really, really important is that you've got one question that you need to ask yourself. You could do all of this on your own. And that's how most people have done it. Or you could copy the laws of nature. You know, we've literally, if you look at the laws of nature, a bird flying in a flock can fly 70% further than a bird flying on its own. If you look at fish, they swim in schools. If you look at animals, they go across the plains in herds. And yet we as investors choose to do it all on our own. It's something that I don't understand. And it's why if you look at that investor test, it's built on the fundamentals of nature. Because just like the laws of gravity, if I drop this, there's nothing that is going to stop this from dropping. It is a fundamental, it is a law. And we as investors get to copy those laws, and ultimately it'll help us get to a lot more success. So I wanted to finish off and say thank you very much. Gabriella, we're pretty much finishing dead on time. It's pretty much 11 o'clock as per our schedule. We are going to take, how long should we take, Gabriella? A 10-minute tea break?
Yes, let's say 10 minutes, and we'll meet back here at 10 past 11.
Great. And so we're going to meet back here at 10 past 11. I can't explain to you how excited I am about the second half of this session, because what I've been doing all along is focusing on the why here and the theory. And what Gabriella is going to go into, she's interviewing our chief investment officer. So she's going to look at the how. She's going to be, we're going to be talking live to tax consulting around the what do you do, including she's going to do the how does our platform work. She's going to talk about what the opportunities are on our platform. So ladies and gentlemen, if you've got the theory and you enjoyed the theory, you've only just started. You've taken the initial step, but now it's time we welcome you on this journey. So I'm going to literally put the screen on hold. I'm going to put the music on, and we will be back in 10 minutes for the practical session that Gabriella is going to be running. And I'm super excited to see you back online.
Some dreams live on in time forever. Those dreams you want with all your heart. Now do whatever it takes hope for at last would be mine. If I could reach higher, just for one moment touch the sky. From that one moment in my life, I'm gonna be stronger. Know that I've tried my very best, put my spirit to the test. If I could reach. Some days are meant to be remembered. In those days, we rise above the stars. So I'll go the distance this time. See it fall, the higher I climb. That the more I believe, all the more that this dream will be mine. If I could reach higher, just for one moment touch the sky. From that one moment in my life, I'm gonna be stronger. Know that I've tried my very best, put my spirit to the test. If I could reach higher, just for one moment touch the sky. That one moment in my life, I'm gonna be stronger. I'm gonna be so much stronger, yes I am. I put my spirit to the test. If I could reach. I took a pill in Ibiza to show Avicii I was cool. And when I finally got sober, felt 10 years older, but fuck it, it was something to do. I'm living out in LA. I drive a sports car just to prove I'm a real big baller, cause I made $1 million and I spend it on girls and shoes. But you don't wanna be high like me, never really know why like me. You don't ever wanna step off that roller coaster and be all alone. You don't wanna ride the bus like this, never know who to trust like this. You don't wanna be stuck up on that stage singing, stuck up on that stage singing. Oh, I know, sad soul, sad soul, darling. Oh, I know, sad soul, sad soul. Sad soul. Sad soul. Sad soul. Shot. I get along with old timers, cause my name's a reminder of a pop song people forgot. And I can't keep a girl, no, cause as soon as the sun comes up, I cut them all loose and work's my excuse. But the truth is I can't open up. And you don't wanna be high like me, never really know why you like me. You don't ever wanna step off that roller coaster and be all alone. You don't wanna ride the bus like this, never know who to trust like this. You don't wanna be stuck up on that station, stuck up on that station. Oh, I know a sad soul, sad soul, darling. Oh, I know a sad soul, sad soul.
Yeah, I'm gonna take my horse through the old town road. I'm gonna ride till I can't no more. I'm gonna take my horse through the old town road. I'm gonna ride till I can't no more.
I got the horses in the back, horse stock is attached. Head is matted black, got the bushes black to match. Riding on a horse, ha, you can whip your Porsche. I've been in the valley, you ain't been up off that porch. Now, can't nobody tell me nothing. You can't tell me nothing. Can't nobody tell me nothing. You can't tell me nothing. Riding on a tractor, lean all in my blood. Cheated on my baby, you can go and ask her. My life is a movie, bull riding in boobies. Cowboy hat from Gucci, Wrangler on my booty. Can't nobody tell me nothing. You can't tell me nothing. Can't nobody tell me nothing. You can't tell me nothing. Yeah, I'm gonna take my horse to the old town road. I'm gonna ride till I can't no more. I'm gonna take my horse to the old town road. I'm gonna ride till I can't no more.
Hat down, cross town, living like a rock star. Spend a lot of money on my brand new guitar. Baby's got a habit, diamond rings and Fendi sports bras. Riding down Rodeo in my Maserati sports car. Got no stress, I've been through all that. I'm like a Marlboro man, so I kick on back. Wish I could roll on back to that old town road. I wanna ride till I can't. Yeah, I'm gonna take my horse to the old town road. I'm gonna ride till I can't no more. I'm gonna take my horse to the old town road. I'm gonna ride till I can't no more.
Homegrown alligator, see you later. Gotta hit the road, gotta hit the road. The sun ain't changed in the atmosphere, architecture unfamiliar. I could get used to this. Time flies by in the yellow and green. Stick around and you'll see what I mean. There's a mountain top that I'm dreaming of. If you need me, you know where I'll be. I'll be riding shotgun underneath the hot sun, feeling like a someone. I'll be riding shotgun underneath the hot sun, feeling like a someone. South of the equator, navigator, gotta hit the road, gotta hit the road. Deep sea diving round the clock, bikini bottoms, lager tops. I could get used to this. Time flies by in the yellow and green, stick around.
Hello, 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 and welcome back. Wonderful to have you all back. I'm very, very excited now to hand over to my colleague, Gabriela Faris. She is head of our revenue. I did do a short introduction beforehand. I will say one thing, we are very, very excited to have Gabby as part of our team. She joined us at the end of last year. She is American by background, studied in America, was part of a company, $1 billion edtech company in the US, and came out to South Africa as part of a global acquisition strategy. And we're very excited to have her join our team, bringing that global expertise to our team. So Gabby, welcome. And I really look forward to seeing the how and the what and getting into the practical session.
Thank you so much for that introduction, Scott. It's greatly appreciated. And hello to all of our attendees today. This session is meant to be interactive and engaging, so please feel free to put your comments, questions in the chat for myself, Scott, or any of our team to see and address or flag. I'd say it's 11 o'clock. We have a packed hour ahead of us, so let's jump into it. Where I'd like to start is just discussing the Wealth Migrate platform itself. So Scott has talked quite a bit about the mission behind the Wealth Migrate platform, his why. We went over our whys together at the top of this session. But what we provide is an elegant global solution to you as the individual investor to be able to really take advantage of these quality investment opportunities across the United States, across Europe, and the UK, without having to go through the hassle of setting up your own structures, paying for complex legal structures and financial arrangements. What we have provided is a truly easy, I would say simple rather, way to create true global wealth for yourself through our online investment platform. And when I say easy, I mean it's super easy. It's 4 simple steps. You sign up to our Wealth Migrate marketplace, complete your profile, fund your wallet, and invest. And we'll go through that just now in this series of slides, and then I'll take you through a live demonstration of actually being able to invest in a global property a little bit later in our session. But first things first, simply go to our website, wealthmigrate.com, register on the platform by clicking on that blue sign up button in the top left corner.
Gabby?
Once you have clicked there, Scott?
There's the audio is coming through. It's cracking up quite a lot. I'm just wondering on your side, is there anything you can do there? Would it help if you put headphones in or take your headphones out and just speak straight?
Okay, maybe this is better.
That's much better. Much, much better.
Apologies. Apple doesn't always get it right, guys. Sometimes the, the AirPods don't work.
Maybe if you just go back to step 1 where you had it from the sign up. Yeah,
sure. So super easy, super simple. Sign up, complete your profile, fund your wallet, and invest. First things first is to go to our website, wealthmigrate.com, and in the top right corner, you'll see there is a blue sign up button to click on. That'll take you to our registration page where you'll be asked to provide your email, password, review and accept our terms and conditions. You'll then be asked to verify your country of residence, as well as self-attest to your investor category. Now we have 4 investor categories to choose from, all with different definitions, but it is important that you select the one that you feel is most accurate for you. If you're an everyday investor, a self-certified and sophisticated investor, an advised investor, or a high net worth investor, and again, those descriptions are there for you. You can change them at any point in time later on in your journey, but this is just a starting point for us to begin your KYC or know your customer process. Once you have self-attested, you'll be taken into your actual investor portal. And you can see here, you'll be asked to complete some additional details of your profile. And this is the nitty gritty in terms of personal information, address. You'll be asked to provide 2 forms of identification, proof of address, and a full bank statement. Our Know Your Customer team does the necessary cross-reference checking, and if all is in order, we'll submit your profile to Lemonway, our wallet service provider, and that KYC verification process typically takes about 48 hours to complete. So again, you can see here, this is where you'll be asked to upload those identifying documents. And then finally, once you have been verified, we'll ask you to fund your wallet. So you can fund your wallet when you stand on the marketplace page, navigate to the wallet icon on the left-hand pane, click on deposit funds to view the bank details for your Lemonway wallet. That wallet is held by Banco Sabadell. And again, you must be verified to be able to view this information. It is vital that you use your unique payment reference number to avoid any misallocation of funds when sending your funds through. And be advised that this is a USD based wallet, so be sure to wire in USD currency. If your bank is not USD based, then you will incur a foreign exchange fee, though we do have some partnerships with institutions that can assist you in limiting those costs. Now that you've funded your wallet, you'll be able to browse our marketplace deals, and you can click on the relevant deal product card to view more information on any specific offering that we have. You'll obtain a full overview of the market and investment summary of the deal. You can also download the relevant product documentation further down on the page. Something I really enjoy about our deal offerings is that we do provide a projected returns calculator, so you can also get a sense of what your returns will be for the length of that deal. And if you decide this is the deal that I want to invest in, you'll simply click on the relevant deal product card, click on the Invest in this deal button in the top right-hand corner, and follow those self-explanatory steps until done. And this takes you in total about 30 seconds. So what I'd like to do here is actually share my screen and walk you through that process of investing. You can see I'll sign in because I already have an account. So you can see here, this is my marketplace, my personal investment portal. I can see here that I am fully verified. My shield is green. I can scroll through current opportunities. We have Pinnacle Corporate Park with Feldman Equities, an office asset with a tenured sponsor and a value add risk. We have Technoplas with MAG Capital Partners, an industrial asset with a tenured sponsor that is considered core plus in risk. And if I scroll down a bit more, I can see that we have a deal currently under review. And I'll explain this a bit more later when we have our Chief Investments Officer joining us. It simply means that a deal is soon to be launched on our platform. We are just in the background finalizing some key components of the deal itself. And then if you scroll a bit further down, you can see all historical deals that we have offered to our market. Something else to note is that we do offer not just real estate investments, but alternative investments in the form of structured notes. Now, we currently do not have any structured notes available for investing at the moment. We recently closed our car manufacturer's note with BBVA and our sponsor Cashbox. Something else to note in the wallets, you can see your portfolio. If you have invested into anything, those investments would show up here. You can go to your wallet and deposit funds as shown, and also withdraw funds as shown. So you have full control over your money in your wallet. Now let's go into a specific deal. This is Feldman Equity's Pinnacle Corporate Park, located in Fort Lauderdale, Florida. You can see some images of the asset itself. It's located just behind the Tri-Rail line, some very stunning office space, both internally and externally. You can understand a bit more about the offering itself. It's a Class A office building located in the Cypress Creek submarket of Fort Lauderdale, Florida. We give you some key points to consider in terms of the offering itself. We also give you a market summary to understand the region a bit more broadly, and specifically the region and the asset as it performs in that particular geographic area. We also go through and provide a high-level investment summary, including the business plan for the asset, as well as some key investment factors that may be of significance to you as a potential investor. I've scrolled past it just now, but you can also see here we're incredibly transparent about both your fees, your returns, net fees, the length of the deal, who the sponsor is, and who the due diligence provider is. We even provide you with an investment category section. Yeah, Scott?
Sorry to jump in, but I just want to emphasize what you just said there, because so often in the financial industry and in the property industry, it's always about gross fees. Okay. And so the feedback that you and I had on the roadshow we've just been on is that when people read the document later down, it's all in gross fees, etc. And for us, what's really important is that from a trust, transparency, alignment perspective, we are trying to show people net fees. We have had an internal debate where we actually want to show gross and net, but specifically, I just want to really emphasize that everything that Gabby's showing you is net of fees. That's the actual cash in your pocket. That's not taking fees off afterwards. And it's just, again, just feedback that we had, Gabby, Gabriella, that you and I got. And I just want to really emphasize that for people,
Definitely. And we'll go through the investment calculator just now, projected returns calculator, just now as well. Something else to highlight is our investment risk category. So typically in the industry, most real estate assets are categorized based on level of risk and equated to level of potential returns. You can see here, our investment risk category has 4 specific categories within it. Core, for properties that are located typically in prime areas with blue chip tenants. They provide stable income and tend to be expensive to buy, and so therefore produce lower returns for the investor. Core plus, value add, all the way up to opportunistic, which tends to be highest risk, highest reward. It does generally involve either situations where an asset is being completely turned around or completely redeveloped and gutted, or a new development where ground is being broken. This type of investment or asset requires carries the highest risk for cash flow and income, though again, does tend to have the highest returns possible. For this particular asset, it is considered a value add. So it's a property with existing rental income, though with some opportunities for the sponsor, in this case, Feldman Equities, to make changes to increase the cash flow. And there is some degree of risk and uncertainty as an investor investing in this opportunity. We provide you with an opportunity to download any documentation provided by the sponsor itself. In this case, this is the deal brochure provided by Feldman Equities. We're extremely transparent about the potential risks that we identify as a part of our due diligence process in vetting this asset. We give you some milestones. And then at the bottom here, we have our projected returns calculator, where if I decided I wanted to invest $1,000, I can see quite transparently that I will be charged a $30 initiation fee, or 3% of what I'm investing. So my total payment to invest in this opportunity will be $1,030. I can see the cash flow percentage and my annual dividends or interest calculated less that 10% success fee. And so therefore what I would be earning year on year and at time of exit. And you can see here again, my projected return. So let's invest in this deal. It looks good to me. I'm excited about it. I'm going to invest $500 into this deal, the minimum investment. Again, my fees are shown here, $15 US for a $500 investment. So $515 will be deducted from my wallet. I will accept all T's and C's. And I even have the opportunity to download the specific agreements, including the private placement memorandum and the subscription agreement for this deal to read through more thoroughly before I accept. And then I'll make my investment. And it really is that simple. My transaction has gone through and I am now considered a investor into Feldman's Pinnacle Park. As soon as this deal closes on the 21st of June, or sorry, soon, later this week, the 1st of July, then my investment will be secured. Now, if at any point in time I decide before the investment closes that I no longer want to put my money into this investment, I can cancel the investment and my wallet is accredited again shortly thereafter.
Gabby, two comments there again. One is that the reason we extended a little bit beyond the end of June was because we had this event today. And we had a bunch of people that had said, please, we've only got the event, we've only got access to be on live today. So we've kicking and screaming have asked the sponsors to delay it for us. So that's why that was. And the second thing was, I know that's a new feature we've just had on the cancellation thing, and it's something so powerful about being able to invest. And if I change my mind or whatever, I can go back and cancel it, and I'm in complete control. I don't have to send an email to anyone, don't have to ask anyone. Obviously, once the deal closes, it's closed, but before it closing, I'm in complete control of my money.
Yeah, absolutely. And I see we have a couple of questions here. One from Neo, who's asking, when does it pay out profits? So for this particular offering, it is an investment opportunity that produces returns yearly, quarterly, and annually. So you can expect to see returns for this generally within the after a quarter, and you're paid out quarterly dividends or distributions. Some of our offerings will be capital growth focused only, meaning that you will only be paid out your returns at the time that the deal exits in 3 to 5 years. So we do add and offer diversity in that sense in terms of both not just the types of assets that you can invest in, but the type of returns that you would be receiving from those assets. Scott, I don't know if you want to speak to that more.
Yeah, look, I mean, I think I did talk about it. The one is an income opportunity, which is an existing building, and it gets paid out quarterly. And just like you've got, here in the cash flow, you're getting paid, during the duration of the deal. And the other one is a growth opportunity where you're only getting paid out on exit, basically. And they're different types of deals which people have the opportunity to invest in.
Definitely. Now, I also see a question here from Warner that asks, what happens if the deal time is closed and there is not enough collective investment to actually make the purchase? So the value of working with sponsors like Feldman Equities, MAG Capital Partners is that they are extremely tenured. These are individual organizations that have been in operating for, in the case of Feldman, over 100 years, and MAG over 20 years. They are soliciting investments from several institutional investors, plus us. We, as Wealth Migrate, are simply one part of that capital stack. So generally the deal will go on. If we fail to raise our portion of that capital stack, then we will return all investments, including the fees paid, to our investors on that marketplace. But generally what happens, especially with these quality and tier of sponsors, is that these deals tend to be fully subscribed quite quickly.
Can I jump in there if you don't mind? Because
sure.
Again, something that when we were on stage and dealing with people in a live environment, I think is so powerful. And why do I say that? Is that when we first started out, we wanted to own the whole deal. Okay, so again, I'm going to keep referring to old world thinking. It's like, I want to control, I want to have everything. But actually, if you think about it, like on that MAG deal, they're raising $25 million. They're raising it in 7 to 14 days, and they're raising it from a majority of Americans in America. I actually think it's far more powerful for us as international investors if we're partnering and investing in a deal that's being taken down in 7 days by Americans in America. I mean, that's showing the significance and the quality of the deal. And we're part of that puzzle, not the whole thing. then if we're trying, a bunch of South Africans or from wherever flying over and trying to be experts in every market, it's impossible. Does it make sense? So it's a very different mindset. But actually, back to Werner's question, it's a much better situation to be in than where we used to be, where we're just a piece of the capital stack than trying to take down the whole deal. Why that's also important, if I go back to that Kensington deal where we own the whole development, now you're an international investor trying to manage a development in Brisbane, Australia, whereas if you were dealing with where it was owned 95, 98% by Australians, that is far, far stronger. You're in a much, much better position. So diversification, quality of partner, this ticks both those boxes massively.
Definitely. Now I see that we're joined by our Chief Investments Officer, Rian van de Vyver. Hi, Rian, how are you?
Gabby, very well. Nice and wet in the Cape, so we feel blessed.
Indeed. Rian, thank you so much for joining us today. You're actually joining at the perfect time. I was just going to talk through how it works, how we structure our aggregate and structure our SPVs and actually deliver what we raise from our investors to the sponsors. So I would love to share my screen and then Rian, actually have you just talk us through components of this. And jump in where and when you can, Rian, and then we'll talk more specifically about some of the current sponsors that we have and the deals that we're offering from them.
No problem.
Awesome.
So how chipping.
Amazing. So how does this work? Well, it starts with our sponsors. We partner with a broad range of sponsors to provide investment opportunities specifically to you, our investor community. We carefully select our sponsors to be the best in class with established track records. And I'll ask Rian just a little bit later on to talk through what that due diligence and vetting process is for our sponsors and for the deals that they present to us. We then provide these investment opportunities that are presented by our sponsors to you on our marketplace. And you saw how quickly and easily you can access those opportunities on our marketplace.
Gabby, just quickly, we're seeing the other slide, not the presenter slideshow, the other slide. We see the slides with the notes.
Sorry, thank you. Okay. All right. You can browse our current deals and opportunities. And then once we have closed a deal for investment on our platform, it has been fully funded or we've reached the closing date, we create a dedicated legal entity or a special purpose vehicle or SPV. And that SPV is a legal company or structure that is set up for that deal in which all of the investors are shareholders based on their differing investment amounts. That SPV is then investing directly into the offering in question through the sponsor. That sponsor will run the asset for the full term of the deal, implementing their business plan as they presented to us and to you. And where relevant, they will make their quarterly distributions. These distributions are paid to you as an investor directly into your transactional account or your wallet on our marketplace.
Gabby, if I can just jump in there, if you don't mind. A few things of importance, I think, to the participants, if you can just go back. In terms of the commercial investment opportunities, so I think where we differentiate ourselves is that we would like to partner with sponsors with capacity. So in other words, what we do within the supply team and within the investment team is that we do a lot of work in terms of the sponsor due diligence, so that when we approve a sponsor, that although there is a due diligence done on the deal level, the level of due diligence at deal level is less onerous than at sponsor level. And that's why we do so much work on the sponsor at inception, and we ensure capacity. But in the end then, once we trust the sponsor and we believe we've got a good quality sponsor, we do the due diligence, but we do not question certain things within a geographic area. So if a sponsor says to us, for example, in Salt Lake City, Utah, this is the rental growth over the last 5 years, we don't go and double check that because we've already DD'd the sponsor. The second thing that I just want to mention, which I think is very important, is that SPV component that you spoke of. So why that SPV is so important is that we are aggregating individual investors at SPV level. And the importance of that is that there's now one single institutional investor into the deal at sponsor level. And that allows us to improve cost and returns because many sponsors do not want to deal with 1,000 people around the world. And through that aggregation of in that SPV, they see us as a corporate, as an institutional investor. Hence, we can get away with a $250, a $500, $1 million raise within a 24 million deal, for example. And then also just another thing that I just want to give peace of mind to investors and to the participants is that we recently got a legal opinion, which we knew, but it's all about rubber stamping, which is important within the world of compliance, is that our SPV is not an alternative investment fund. Hence, the SPV is not a collective investment scheme in the UK. So in other words, what that means is that we can rely on exemptions in terms of prospective directives, in terms of accepting EU investors into our structures and things like that. So in essence, the legality of our SPV got rubber stamped as well.
Brilliant. Thank you, Rian. And we'll talk a bit more about our compliance process and how we select and designate our sponsors just now. But I think that provides great clarity for our current investors on this seminar, just to understand the layers of compliance and risk management that we offer. And just here, speaking to it again, we are an authorized Category 1 financial service provider, offering real estate and other asset class opportunities to investors across the globe. We cover investor due diligence, or the KYC, Know Your Customer AML process. We do heavy sponsor due diligence, deal level compliance with our digital wallets provider, Lemonway. We can offer money movement and holding clients' money compliantly. Structure, setup, compliance, and reporting, as well as adhering to marketing, investor acquisition regulations, and data protection guidelines like GDPR in Europe, for example. How we do this is...
My apologies, if I can just jump in there again.
Sure.
You invited me to jump in, so I'm doing it, so my apologies for that. And I think for the participants, the significance of this authorized Category 1 FSP is the fact that within legislation, there is now protection for investors. If there is, for example, negligence or whatever the case might be, if the solution is a non-FSCA solution, a service provider can easily just say, you know what, it's non-approved, we're not regulated by the FSCA, we disclose to you, you can lose all your money, you actually don't have any recourse, right? So with this FSP of ours, it provides investors with protection in terms of legislation. And I think that is a key point.
Absolutely. Absolutely.
And then the second thing, Gabby, sorry, about our wallets is also that what the implication is for investors, it's peace of mind. We call it cash custody. Mm-hmm. Cash custody is simply the control over the movement of the cash. With whom does it sit? And it does not sit with us. So that means that we provide instructions of where the money go, but we do not control the money. And in numerous cases where things went wrong in the past, not with us, but with other providers, is that the companies had the ability to dip into investors' funds. which we deliberately decided not to do through an external payment service provider and external cash custody.
Absolutely. And I think that's so critical to highlight, Rian. And that's who Lemonway is as our digital service, digital wallets provider. They are certified and accredited in the EU. So they are held accountable to all EU and UK financial regulations, the regulatory bodies. And a very critical decision that we made some time ago to partner with them to allow that independence from a money holding and money movements perspective for our investors. We also partner with Alpha Cube Capital and Capital International Group in order to fulfill all compliance regulations and mitigate risk for both ourselves, our sponsors, and most importantly, our investors on our marketplace. We have also very recently partnered with Tax Consulting South Africa, one of the country's largest independent tax practices. They have been around for quite some time. They're composed of over 140 professionals that offer an extensive menu of tax offerings, including tax immigration and tax guidance when investing offshore through structures similar to ours. And we'll actually hear from Tax Consulting at 12 o'clock today, where you can ask them some additional questions about what they do, understand how they can support you as an investor in our structures. Now, this is really where we get to the meat of it and why I'm so pleased that Rian is here with us, and that's to speak specifically to how we select and designate our sponsors and our deals. So Rian, do you want to take it away here? We have just the high level kind of three-part process, and then we'll go into the many considerations, that mind map that you created for our due diligence process for our sponsors.
Definitely, Gabby, thank you. So just to start off with, this is almost like how we identify sponsors. So the key point here is that we look at the current portfolio composition, and by that I mean the spread between growth assets or growth deals, income deals, whether it's based in the US, whether it's based in the UK, whether it's based in the EU. We also recently introduced, and we're working on it, is something called an investment thesis. And what we do there is we've identified the different sub-sectors within real estate as an asset class, and we said what are the drivers of returns. So then based on those drivers of returns, we go around the world and we identify, based on those drivers of returns, where do we find supporting factors or fundamentals. And based on that, we now know that we need to go and look for multifamily in Utah, or we need to look for office in this area, and so on and so forth. So it points our search for sponsors very specifically in the areas where we believe there's supporting fundamentals for returns. Okay, from there onwards, if we've identified a sponsor, we have what we call vital signs. And the vital signs, it's about 8 critical aspects that a sponsor needs to satisfy before we even go into a scoping report. So in other words, think of it as a hurdle as a sponsor needs to jump over to even come into our system. It's our minimum criteria. Then we do what we call a scoping report. And the scoping report is just a basic analysis of that sponsor, where I, as Chief Investment Officer, then decide, do we continue with a due diligence with this sponsor? So then what we will do is we will then have an introductory meeting with the sponsor. We will have an outreach, and we will determine whether there's a fit or not, and whether we can do a deal way. From there onwards, we've got documentation that we send out where we get information. We call it our listed application forms. And then we go into a due diligence report. If need be, we have a follow-up conversation with the sponsor in terms of the sponsor itself. And then it goes to our investment committee for a decision in terms of the sponsor. So maybe just going a bit deeper into this DD or due diligence process of the sponsor. So if I can start right top where it says, is it an established entity? What is very important to us is that sponsors must have good corporate governance. What we mean by that, are they registered? Are there annual filings in terms of their company registration in place? Do they have a good standing with the tax authorities? Because it's very simple. A sponsor is responsible to manage an SPV within which we invest. So if that sponsor doesn't have good corporate governance in terms of their own business, there's a big risk that it's going to be the same in the SPV they're managing on behalf of our investors. Then the second thing that we also do is we look at financial discipline and soundness. So we need to have sight of financials. And we need to know, once again, did they submit financials? If not, do we have management accounts and is it up to date? And it's once again about financial discipline. So if they don't have up-to-date management account in their business, we're going to struggle to get information on quarterly distributions from that sponsor. It's as simple as that. And why the financial soundness is so important. And there we look at things like, are they solvent? Are they liquid? And so on. Because we want to reduce the risk of misappropriation of funds. If a sponsor has a cash flow issue or a liquidity issue in their business, there could be a risk that they could dip into the SPV funds just to breach them a bit and things can go wrong. So that's quite important. And then also we look quite a bit at growth dynamics. What we mean by that is, how did their assets under management change? How did their revenue streams change and so on? Because let's say they had a very strong upward trajectory and suddenly there's a dip. We need to understand what happened. There's an event in their business. So then if we look at the niche, we want to deal with specialists. We don't want to deal with generalists. So from that point of view, it is quite important for us to understand what is this niche. Now, a niche could be a specific asset class, or it could be a specific region. That a sponsor only does property in that specific area. And what we need to know is, what is the experience, first of all, of the company, and then of the team within that niche. And ideally, we want to look at a minimum of 10 years kind of experience as a minimum within a specific niche. Then we need to understand, how do they execute on their niche? In other words, they're a specialist in an area. What do they do so that we can unlock value for our investors? And more important is, do they outsource stuff or certain functions? And if they do, what is the responsibility of that outsource partner, and how do they control, or how do they manage, or how do they govern that outsource partner? Then if we go to the top left where it says team, we do quite a bit of work. First of all, on the background and credit checks of the team, founding partners, directors. But we need to understand how big is a team, and also what level of independence is there within that team. Ideally, for example, we want independence between the acquisition team and the investment committee. We want to make sure that the sponsor do not fall in love with a deal, and there's no checks and balances along the way to caution, if I can put it like that, right? We also look at how are decisions made. So who makes those decisions? Does someone have a special vote, a proxy vote, or a special vote where they can override the decision by an investment committee? Now, a further thing that's quite important in terms of that team is that we need to understand what's the relevant qualifications of the team members. Very important, relative for that specific asset class, relevant for that specific asset class, and what's the relevant experience for that niche or that asset class. And we also have a look at the depth or the reach of that team. If they say to us they do turnkey, we want to see if I look at that team, that team can cover all these areas of this turnkey solution. Otherwise, we've got either concentration risk or we've got execution risk. Then in terms of track record, it is quite important for us to understand historically, what did a sponsor do in terms of their deals, in terms of IRR and cash on cash. But more importantly, we go back and we say, on these deals, what did you forecast and what did you actually achieve? The last thing is, we don't want to overpromise to investors and underdeliver. We need to have a high degree of certainty when we publish returns on our platform, that those returns will be realized. Also, we go into the closet, if I can put it like that, to determine, did any deals go wrong? Why did it go wrong? And what did you do in terms of your process to prevent a similar occurrence happening? And then in many cases, you get outliers. So you will see, let's say, an average IRR of 17, cash on cash of 7, and suddenly you see a deal that sits with an IRR of 4.5. We need to understand why that was an outlier event. So we just don't take returns on face value. We stress test the returns and we understand the returns. I think that is quite important. And then lastly, in terms of capacity, as I've mentioned at start, it's very important to us to deal with sponsors that's got a proven capacity. Because we don't want to do all this work and then we get one deal a year out of this sponsor. Because our community start to trust the sponsor, they start to trust the quality, they start to understand the deals. And then just lastly, in terms of the synopsis to the investment committee, so apart from preparing a complete due diligence document that can range anything from 18 to 30 pages, we also provide a synopsis. Think of it as a SWOT analysis, where we look at things like what's the positives of this sponsor, what's the negatives, what's the risks, and so on. And why the risks are important, Gabby, is that it gives us certain things that we need to consider if we enter into a deal, so that we can specifically manage that to mitigate those risks. So a mouthful, but hopefully we illustrated that it's quite an onerous and an in-depth process.
But one that's so critical, and I think speaks to the caliber of sponsors that we are privileged to call partners and have offerings with on our marketplace today. And what I love about the due diligence process that your team does, Rian, is that we do try to make as much of that as we can available to our investors in the sponsor descriptions on the deal offerings themselves. We offer recordings of sponsor interviews so that as an investor, you can watch a recording with Rian and the sponsor, or our head of community, Lee, interviewing that sponsor to learn more about their background and actually hear from the sponsor directly on their experience and their track record and success.
Gabby, and can I just, it is not that we don't want to be transparent in publishing a full DD doc.
Right.
The success of our due diligence lies on confidentiality agreements that we have with sponsors. So if we disclose certain information which they believe are confidential, we're going to struggle to do full due diligences. And that's why we started doing, for example, on a sponsor, what we call a brag sheet, where we really provide the nuts and bolts of that sponsor to our community.
Yes.
But so it's just important for the participants to understand it's not a lack of transparency. It's rather to protect confidentiality, that we can get access to information to do a proper job.
Yeah, absolutely. And I think also recognizing that many of the sponsors we work with are still private companies, they're not publicly listed. So when they are providing these details, they're actually providing their financial statements, their income records and everything. So it's incredibly sensitive information that we want to be mindful we are keeping confidential. and not sharing with others. Something else I just want to highlight here is that we actually select and designate our sponsors on our marketplace, specifically titling them as either tenured, established, developed, or emerging. And what we'll see just now is that of the 3 current offerings that we have on our marketplace, 2 offerings are with 2 tenured sponsors and 1 with an established sponsor. And these are quite significant metrics to be held to. As you can see, an established sponsor has a management team with over 40 years of experience, an operating age of 7 to 15 years, and assets under management of more than $500,000. A tenured sponsor, assets under management of more than $1 billion, with a management team of more than 50 years combined experience and operating for more than 15 years. So pretty heavy hitting in that regard. And if we just look here at who our sponsors are, some of our sponsors, you can see them listed here. What I'd love to get into is how we actually select and designate our deals. So the deals that our sponsors are currently offering to us. And Rian, if you can just touch on this briefly.
Yes, I will definitely do so. So once we approve the sponsor, there's a continuous outreach to the sponsors to determine whether there's new deals. Then once there is a deal, we get certain collateral from the sponsor, and we typically are invited to an initial webinar where they introduce the deal. From there, the supply team go and we do an internal due diligence report on the deal. And what is very important there is that we actually test the reasonability of the figures of a deal. So it's, once again, we're not just taking it on face value, but we are testing if it's reasonable, because that results in faith in returns. Secondly, is we also do internal research about the market dynamics where that property is. And a good example would be if you look at the Utah deal, Salt Lake City, which we will be putting live soon. I think it's maybe live already. Is where we looked at how Utah and Salt Lake City supports multifamily as an investment. So we do our own research. From there onwards, there's an assessment of the due diligence report, and then we have an interview with the sponsor where we question them about their deal based on our initial due diligence. From there, we prepare a final due diligence report, which goes to the investment committee. And as part of that due diligence report, there's also a synopsis in terms of that deal. Once again, what's the fundamentals that will drive returns? What's the positives? What's the negatives? What's the risks? And what's the rationale for this investment? And then there's a recommendation. So once, it's not just dumping a lot of data, it's actually analyzing it and getting to, once again, to a SWOT analysis, to a conclusion. From there, it goes to the investment committee for their approval and consideration. And this is what you've spoken to earlier, Gabby. Then we engage with the sponsor to determine what is their timelines for capital raise, and also if we can secure capacity for our community. Because it's quite important to us that we secure capacity. We don't want to go through this process, investors show interest, and then we don't have capacity. And that's something that we manage and monitor regularly with our sponsors. And then, as you've mentioned, there's also then a deal-specific webinar with the sponsor, which is made available to our community, to investors. But the work doesn't stop there. From there onwards, we then do what we call deal tracking and deal monitoring. So my team go and we identify when do we need to earn certain distributions. There's a forecast of what we should receive, and that's then measured against what we have received. And the 2 things of importance there. One, we cannot wait too long for funds from sponsors. And the second point is that if there's deviations, it's a flag that we need to engage with a sponsor. So we do quite detailed deal monitoring, and from there onwards, there's deal reporting. As the participants and investors know, There is reporting at deal level. So if a deal does a quarterly report or distribution, then that report is sent to or shared with our investors. But there's also a report coming to the investment committee where we can look at deviations and decide what we need to do in terms of something that's worrying to us. And then lastly, we engage with the sponsor when it's time to exit the deal so that we align with the execution strategy in terms of exiting that deal.
Absolutely. And I just want to highlight here your incredible team that sits behind you, Rian, that helps to make this a reality for our investors. You have your investment committee and then our deal operations team that is doing all of this work to find sponsors, to engage with sponsors and vet the deals, to complete those due diligence reports, and to make final decisions on vetting a new sponsor or a new deal.
Yeah, and also we've recently hired an intern, Dean, which is not yet added since he's an intern, but he's already adding quite a lot of value in terms of the team.
Yeah.
The other thing, Gabby, that I think is important is that a report that we shared live at the events was our performance report for 2020, which is right through COVID. And I highly recommend that people take a look at that if they want to see track record and performance, which again, the team's looking at. You know, if you run any good business, you've got budgets to actuals. So it's actually very useful. You know.
Absolutely. And I have a question here from Rachel asking where deal reports are posted. So all deal offerings, all information on them is available on that deal page that I showed you on our marketplace. And then we do release to the investors in those deals quarterly updates on performance of the asset. And then Rian's team is working on producing quarterly reports for all of our community to understand performance across all of our deals. Great.
There's also a quick question that Artie asked up there. Can you say something about the costs involved in withdrawing income, say quarterly dividends from wallets? My experience with other investments is that the bank fees, etc., can impact quarterly withdrawals from an overseas wallet. I just don't want us to miss it.
Yeah, absolutely. So great question, Artie. On our marketplace, you have access to your digital wallet. So when we pay those distributions, it actually goes into your Lemonway wallet, your digital wallet. Now, that is inclusive of all fees that we charge you. So your return is provided to you less the fees the success fee that you would see. If you decide to withdraw that money from your digital wallet into your personal bank account, you may be subject to transfer fees from your bank or foreign exchange fees from your bank. So that's something to really look into with your personal banking provider to understand what some of those costs might carry for you individually. Just quickly, I see it's 12 o'clock and we are joined now by our tax consulting partners, specifically looks like we have Joshua with us from Tax Consulting. I want to make sure that we have time to just quickly go over our newest sponsors and deals, and then I'll ask Joshua to hop on camera and join us for our Q&A. But let's just quickly speak to this. And Rian, please feel free to jump in here to speak to any of the current sponsors and deals that we have. We've discussed them before. Feldman Equities is actually not a new sponsor to Wealth Migrate. We offered our first deal with them in December 2020, but they are, I think, one of our most established sponsors as an operating company. They have been operating for over 100 years, so truly a family-owned legacy business. They have operated and succeeded through 7 recessions in those 100+ years of operating. As a firm, they have invested over $100 million into their own capital into their investments, and they have an aggregate 3 billion assets under management. Just, I think, kind of astounding the breadth of experience and depth of experience that this partner can offer to us. And they are specifically invested in commercial real estate development in the United States. And for the past 30 years have developed and acquired over 11 million square feet of office and retail properties. So just truly incredible to have them as a partner. What we have now actually closing today, but I do want to speak to it quickly, is Pinnacle Corporate Park, located in Fort Lauderdale, Florida. This is an office asset that is considered a value add Class A office building. This is what everyone saw me invest in earlier earlier in the hour on our marketplace. But just, I think, an incredible opportunity and one that we are very privileged to be a part of.
Gabby, if I can just one or two things in terms of that deal.
Sure.
I think the first thing here is that, as Gabby has said, it is A class. So the key point here is that there's not a lot of investor capital used to do renovations of a property. So the money that's spent goes direct into creating value for investors. They talk about changing, upgrading a lobby and things like that. It's minor. It's not that they need to be a full exterior renovation or whatever the case might be. A further critical point is that we're sitting with 92% occupancy, so very low vacancy rates. But also what is very key there is that the spread or the diversification of the industries that's represented as part of the tenant profile is very diverse. So it's not a case of if a industry suffers that we're going to run into high vacancy rates, for example. A further key point is it's very close to transport facilities, the interstate as well, and there's proper parking. And a further thing is that what we like here is, in terms of the threat of COVID, is that they've got technology in their building where they continuously freshen the air, which decreases the risk of COVID infections, which we believe take this big uncertainty of office and demand for office space. It lessens it, or it takes it off the table.
You know, it's interesting, Rian. I want to add one extra thing, which is a little bit of humor, actually. And in America, they call it curb appeal. And I go back to how this whole webinar has been, you know, from Rich Dad Poor Dad and my 20+ year journey. 20 years ago, if you'd said that I could invest in that building, just the way it looks from the outside, it's incredible. I love all the real important things that you've said, but actually just to be able to have that building in my portfolio makes me very excited as well.
Absolutely. And I think you touched on something important here, Rian, which is why invest in an office asset in today's times where we're all logging in from home and working remotely is quite common. But I think the performance of this property specifically through 2020, you know, it remained resilient. They've maintained 100% collection on rent from all of their tenants. If you look at to your point, Rian, as well, the diversity of their tenants, but their tenants tend to be law firms, legal and financial advisors, the like, where you will need to actually meet in person with those advisors or individuals in order to conduct business. We're seeing that this is generally a high performing asset and one that remained resilient through 2020.
Definitely. And if I can just say one other thing about COVID, because I mean, I think that's the biggest uncertainty for investors, is how it's going to impact demand for office space. So the key point here is that we believe that COVID can actually create an opportunity. So historically, people were put together into little cubicles or all bundled together, you know, because we need to save office space and so on and so forth. Where with COVID, we believe that people will go back to offices. They will sit further apart. So suddenly, companies need more rentable space. So actually, what you earn per square foot or square meter of rentage go up because of this new dynamics of COVID. I think that is quite an important point. And the second thing is certain industries like advertising. You need people to work together. People must meet, people must discuss. And we believe that there will always be a demand or a need for office space, given those type of industries and businesses.
Rian, what's interesting, the CEO of JP Morgan's also come out and told everyone to be back in New York by September. So, you know, I think the pendulum has kind of shifted. It was too far this way, it shifted too far this way, and it'll come back somewhere in the center.
Yeah.
Just pivoting now to a newer sponsor of ours, MAG Capital Partners. They specialize in sales leaseback and industrial real estate investment in the Midwest United States. Again, an established sponsor with over, I think it's 40 years combined experience amongst their management team, operating for over 10 years, and assets under management, I think, does exceed I don't know, Rihanna, sorry, it's failing me, but it is a sponsor. They are a sponsor that is considered quite established by our category. And so what we have with them now still open for funding is Technoplus, an investment industrial space in Mansfield, Ohio. This is quite an exciting opportunity. It's our first industrial real estate opportunity on our marketplace, and one that we believe earns extremely strong returns. And what's wonderful about industrial and specifically sales leaseback is that the returns tend to be quite stable given the actual components of the arrangement between the operator and the tenant. Rian, I don't know if you want to speak to this maybe a bit more.
Yeah, I think what is quite important is that that we've got a triple N lease. What that means is that the tenant is responsible for insurance, rates, taxes, maintenance, and so on of the property. So in essence, what happens is that we've got the rental that's collected basically goes into the pocket of the investors. It's not that we get a gross yield with lots of deductions and the net yield is quite low. A further point is that Technoplus recently acquired Nanogate, and Nanogate is actually the operator or the tenant, and Technoplus is the guarantor for the lease. And this is the only operational property for Nanogate. So talk about skin in the game. If they cannot pay the lease or the rent, they don't have a property to operate from. So not only do we have proper guarantees in place in terms of a lease of 20 years, it's the only operational property for Nanogate. A further key point is Technoplus and Nanogate's got a global footprint. So we're talking about big corporates here. And a further thing that I just want to mention is there is what we call a preferred return. So what that means is that MAG Capital Partners, out of cash flow, our investors get that preferred return first. And it starts, if I remember correctly, and it goes up by 0.25% every year. And the targeted exit date is 5 years. So it's not a cash-on-cash return where we're hoping, if I can put it like that. There's much more certainty because it is a preferred return. And it is only one tenant, a 20-year lease with a guarantee in terms of that lease. So we believe we've got solid rental streams coming through. Also, a key point is there's quite a big discount by acquiring a property these days instead of replacing it. So in other words, we're buying at a lower price than the replacement cost, which means there's already embedded a potential for capital growth, capital appreciation.
Absolutely. Absolutely. And for those not familiar with Technoplus, they are a leading global designer and manufacturer of precision plastic components and other related components or products in the automotive, industrial, electrical, and mechanical industries. They also have a almost 100-year history and production facilities and sales offices around the globe, generating more than $600 million in revenue annually. So they are quite an established guarantor, and the property that they have acquired and the company that they've acquired here in this offering, Nanogate, they work with first-class references from Airbus, Audi, BMW, Ford, Porsche, Jaguar, to supply plastic products to that market, specifically in the United States. So quite an established rentee, if you will, or rentor rather, and guarantor and partner to MAG Capital Partners for this offering.
Gabby, and also if I can just add two things, you said that we're looking at a solid guarantor. First thing is that Daimler is their biggest client and it makes up 12% of revenue. So it's not that we're running a risk there that they lose a client and suddenly 60% of revenue is gone. So they've got a diversified client base.
Absolutely.
Nanogate itself got about equipment of about $48 million. So that property value, that equipment value alone provides sufficient cover in terms of the rental liability. And also based on the revenue, the rental is about 2% of revenue. So the rental as a percentage of revenue is also very small, which gives us a lot of comfort in terms of that solidness of Nanogate and Technoplast as guarantor.
Definitely. And I just want to highlight here, because we've used a lot of jargon, what single tenant means. So that is a 100% occupancy upon purchase. In this case, MAG purchased this establishment with Nanogate as the tenant, Technoplast as the guarantor. These buildings are typically in what we would consider mission critical locations, such as headquarters or profit centers. In this case, in Mansfield, Ohio, it's in a core artery in the United States, in the Midwestern United States, for distribution of this manufactured product. And what a sales leaseback is essentially MAG, a real estate asset that is sold to MAG and simultaneously leased back to the seller, in this case, Technoplast. And what that does is it frees up the seller for dormant equity from corporate real estate to be redeployed into significantly more productive business uses. They can use it as a tax write-off. And the tenant, in this case, again, Technoplast or Nanogate, is both contractually responsible and directly motivated to maintain the property. Whereas MAG Capital Partners simply holds the deed for the property and receives that consistent rent annually for the length of the lease.
Gabby, then just maybe a risk that an investor could say there could be with a single tenant is you've got a single tenant 20-year leaseback or rental agreement. So the risk is if Nanogate goes under, we're selling with the property, kind of thing. The key point here is in that 20-year term, there's only 2 points to review or renew this lease. After year 10, after year 20. We're out at around about year 5, year 6. So it's before that mission critical first renewal come up, we're out of the deal already, which limits potentially that risk of a single tenant. So I just want to bring that under the intention of the participants as well. It's a low risk in terms of that single tenant and a 20-year lease.
Absolutely. And you can see that here highlighted under the investment risk category as well, where this deal is considered a core plus risk level investment opportunity. So if you have more questions about Technoplast or want to invest in it, it is open for funding now. It's going to be closing later this week. So there is still an opportunity, if you have not yet, to create your profile today, be verified and fund your wallet, and hopefully take part in this opportunity before it closes at the end of this week. And then our newest partner, Clear Capital Partners, is a private equity firm specializing in multifamily real estate. They are considered a tenured sponsor. They have over 800 million assets under management with a historical return of 21% on all properties sold. Clear Capital is actually based more in the Midwest to West Coast of the United States and operating for has a track record of over 20 years combined management experience from their 20 years and combined management experience from their management team of even greater time. I think it's about 40 years combined management experience from their management team. And what we're offering with them.
Gabby, sorry if I can just, so the same 4 founding partners that basically started working together in 1988, they are still together. So the 4 founding partners have over 100 years of experience. And they've got a core team of 18 employees, of which 9 are core, including those founding partners. So we're really looking here at a very established, tenured sponsor.
Absolutely. And what we're offering with them, this is a deal that is still under review on our marketplace, which, as a reminder to those those still with us. Under review simply means that Rian and his team are finalizing some components of the deal before making it live and open for funding for our investment community, though we do anticipate that this will be live and available to be funded, available and open for investment from tomorrow. But this deal is a low density multifamily property located specifically in Salt Lake City, Utah. It consists of over 126 units across 9 buildings, and has a strong current occupancy rate of 97, almost 98%. The asset itself is considered a value add risk opportunity. The investment case for this deal is supported as well by strong economic fundamentals associated not just with multifamily as a real estate subsector in the United States, but also with factors like current supply constraints of this asset in this particular region of the United States, as well as job growth, proximity to high quality schools, universities, entertainment, health, and economic hubs in Utah, specifically in the Salt Lake City metropolitan region. Rian, do you want to speak any more to this opportunity specifically, or multifamily in Salt Lake?
I think what is quite important, that out of the 128 units, 63 units, there will be interior renovations. There's not a lot of exterior renovations that need to happen, and what they're going to do apart from the interior renovations is they're going to work on the amenities. Things like having a dog park or a dog play area, a barbecue area, things like that. So out of the capital raise, only $1 million goes into renovations and improvements. So once again, the money that is spent goes straight to bottom line, if I can put it like that, because it's not a lot of value add that need to happen. Furthermore, 88% of these units are 2 bedrooms. And Clear Capital suspects that your typical demographic will be a family. So 2 bedrooms speaks to families. Further key point is you've mentioned that it's occupied 97%. The vacancy rates for the Salt Lake County sits only at 4%. And also what we're looking at is average rental growth over the last 5 years of just over 6%. And in these projected returns, we only worked with a 5% vacancy rate and a 3 to 4% increase in rentals. A further key point is that the property was acquired at a 25% discount to replacement costs. And we cannot sufficiently stress the good fundamental factors supporting this investment. Multifamily, 16 schools in just the surrounding area, hospitals, there's an airport. So everything that a family would be looking at is in the direct surroundings of this property. A further key point is that opposite landing point, there's a new development, more luxurious, higher rentals, which once again underpin this rental growth story that we're talking of. And the same in Salt Lake City, downtown Salt Lake City, new developments, much higher rental demands. So this is a sweet spot in terms of where it's positioned, in terms of supporting factors. We believe this is a really good opportunity.
It's a very exciting opportunity, and again, one that can be made available to you to invest in from tomorrow. So if this is of interest to you, if you believe in the opportunity in multifamily, specifically in the Midwest in the United States, this is certainly an opportunity that you don't want to let pass by you. Would encourage you to create your profile, become verified, and fund your wallet to take advantage of this, because it is closing quite soon. As you can see, our closing date for this deal is next week. So it is one that we believe will fully subscribe quite quickly, and therefore one we wanted to flag and bring up to all of you now before it actually is open for funding on our marketplace.
And I think, Gabriella, the essence of what you're saying here is a fundamental shift in behavior change. So when we first did deals, back to the question someone asked right up above, we'd be raising the money, we would have 90 days, and only once we raised the money would the deal close, etc. because we're participating with the best partners out there now, these things are closing in a week or two. And so my recommendation, I'm not giving you advice, I'm just telling you what I do, is I fund my wallet consistently, not knowing when the next deal is coming, but knowing that Rion and his team are consistently bringing good deals. And then I can just fund these deals as and when they happen. Now, why the power of that is that it allows Rion to negotiate. In the past, this deal would come along, and if it was closing on the 5th of July, we can't help you. We need 60 to 90 days, which means we weren't getting access to the best deals. Now, by doing the wallet system, we're getting access to the best deals. So as investors, the downside is it means we have to pre-fund our wallet and kind of, there's a bit more urgency. But the upside is if there's urgency, it's a good quality deal compared to it sitting there for 90 days that no one else wants access to.
Absolutely. So with that, I just want to thank Rion again for joining us today. Thank you so much, Rion, for your time.
Thank you for the opportunity, and to all the participants, thanks for your time. It was a privilege. And to Tax Consulting, my apology for stealing 24 minutes of your time. But hopefully we added value in this extra time. So thank you very much. Much appreciated.
Absolutely. And with that, I would love to introduce Joshua Baju, Director of Africa for Tax Consulting South Africa. Just to join us, hop in, Joshua, if you're here.
Hi, Gabriella. Good afternoon, everyone. So Gabby, I'm just joined here by Thomas. We're just using one laptop to prevent any bouncing of sound.
Okay.
So I think Thomas will just start with a brief overview of the technical aspects, the different taxes applicable, dependent on structures, individuals, and any specific tax considerations. And then we can move over onto how to save tax.
Wonderful. And are you guys able to jump on camera?
Hi, Gabby. Just joining on camera now. Have to move this across the conference room to the other side each time. But
That's
yes,
fine. It's nice to put a face to the name, so it's appreciated that you're on camera. It's good to see you again, Tom.
Likewise, and thanks for having us. So to start off with, understanding the tax perspective on your offshore investments, it's important to understand the tax system in South Africa as a whole. The intention here is not to get into any detail, but just to explain the basis for taxation in this country. South Africa operates a residency basis of taxation, which means that South African residents are subject to tax on their worldwide income. There are certain exemptions and exceptions and rules that must be considered, but the general premise is that if you're a South African resident, you must disclose and pay tax on income from any source across the globe. Now, residency is determined by applying two tests. The first is the ordinarily resident test, which looks at whether your permanent or real home is situated in South Africa. For someone who lives in South Africa, being internationally mobile and without an established home in another jurisdiction, this determination is simple. You would be a resident. The other test applies where your permanent home is situated elsewhere, but you're considered to be resident in South Africa on the basis of your physical presence in this country over a period of 6 years. So let's accept, just for purposes of this discussion, that everyone in the room is tax resident in South Africa, which will form the basis of this discussion.
Can we just say that quickly, Tom? I think, we've got investors from 66 different countries, and we do acknowledge that there are other people that might come from other jurisdictions. And what we're trying to do here is provide partners, but each country you will need localized expertise in that country. Does that make sense? And
Yep.
We're not trying to, tax is very difficult because you can't provide generalized advice generally on tax. Like each person needs to individually, get that. But what we are trying to do today is two things. We're trying to show people that we don't have all the answers. Gabriella and her team and myself and whatever, we're not sitting here trying to be tax experts. Our job is to go out and find the best partners in yourself. And one of the reasons I liked you, as Gabriella has already said, 140 different practitioners. And then the second thing is you're just giving people an overview, but at a personal level, they need to be able to talk to you guys one-to-one.
That's an excellent point, Scott. I mean, every situation is different and it's subject to so much nuance, it's impossible to give a catch-all answer. Just on the point of residency, those two different tests, you may not spend time in South Africa generally, but if your intention is that you will permanently live in South Africa, or your interests are too closely centered in South Africa, your wife, children live here, even if you're abroad, you may still be subject to tax in South Africa on a worldwide basis. Now, that's where we consider the application of, for example, a double tax agreement between South Africa and another country. Whether that's simply just to determine an exclusive country of residence or otherwise the manner of tax in respect of different types of income. And like you said, Scott, it's an excellent point. No two situations are exactly alike. You really do need that niche consultation and discussion and solution-driven mindset from a practitioner.
And remember what I said, you've got crisis investors and you've got strategic investors, and the whole purpose of today is about strategy.
Absolutely. You know, when it comes to tax, we like seeing the tax question raised at the outset of an investment, ideally, and not just before you want to pull out your return on interest or after the fact. Tax planning, it's in the name. It's only effective when you attack it ahead of time, and you can craft the tax position to be taken around your investment strategy. Another very good point is that you can't let tax drive all of your investment decisions. Tax by its nature follows investment. You can't have the tail wag the dog, so to speak. So definitely, once you've distilled your intention from an investment perspective, that's when you ask the tax questions.
I also love that saying by, you know, and again, I want to say Robert Kiyosaki, but I'm not sure if it is him. People always complain about paying tax, but tax is a nice problem because it means you're earning an income.
Well, you know, I tend to say to clients something very similar, which is profit less tax is still profit. At least you get to stay out of jail. You know, you don't end up in hot water and with all of these additional expenses just to keep yourself out of trouble. But I mean, that said, generally from an investor's perspective, the types of tax that you'll see are fairly similar, although the manner in which they apply will differ. Capital gains tax, for example, is arguably the most relevant, depending on your investment strategy. You will encounter C tax if you dispose of assets in South Africa or abroad, if you're a South African resident. So certain assets are subject to relief, and this is also in terms of double tax agreements with the country in which the investment is located and the country in which you're a tax resident. It doesn't have to be South Africa. But perhaps most important here is just to generally discuss CGT and how CGT is determined and taxed in South Africa. Without going into all the gory, boring detail, if you're at the top tax bracket personally as an individual in South Africa, your maximum effective tax rate is roughly 18%. This will never exceed 18% for individuals. But if the person that has realized the asset, disposed of that asset, is a company, then that goes up to 22.4% effective. It is a little bit different for foreign shares, though. The Income Tax Act, for example, provides relief, which determines that if you derive a gain from the disposal of foreign shares, that gain is tax-free if you held more than 10% of the shares in that foreign company, and you held the shares for at least 18 months, and the shares are disposed of in a non-resident person at market value. Further than that, you've got dividends. Now, dividends, we should probably, from at least the South African tax perspective, differentiate the two taxes levied on dividends, which are income tax and dividends withholding tax. Withholding tax will be levied in terms of the laws of the country where that company is situated. But this may be subject to a treaty, like I said, double tax agreement. Generally, where there is a treaty, the withholding tax will not exceed 15% if the recipient's a natural person. Although some treaties will impose a lower limit, perhaps 10% or 5%, depending on the country in which you're resident and the country in which the investment is held. From a South African tax perspective, dividends will be income tax and dividends will be levied. And the treatment depends on your shareholding percentage. If you hold at least 10% or more of the shares in that foreign company, that's exempt in South Africa. Any dividend you receive is not subject to income tax. There is a disclosure that must be made, and that's pretty consistent with revenue authorities worldwide. But if you own less than 10% of that foreign company's shares, from a South African perspective, the exempt portion is then represented by a ratio of 25 to 45, which effectively means that 44% of all foreign dividends are exempt if you don't meet that 10% threshold. Lastly, interest, the same with dividends, may be subject to a withholding tax in the country in which that money is invested, and income tax in your country of residence, like in South Africa. Now, the treatment there really depends on the country of source. Some treaties will permit the country of residence to tax interest only, with no withholding tax in the country of source where the investment is, and taxed at your marginal rate. Where interest is subject to income tax in that source country, however, you may qualify for a tax credit in South Africa. Now, just as a very general point, double taxation is not something that is ever acceptable. Doesn't matter which country you're a resident in, where any amount is invested. Now, double tax relief is generally provided in the domestic provisions, legal provisions of the countries concerned, and especially your country of residence for tax purposes, which, just to throw in, is different to your immigration status. Otherwise, you can get that relief in terms of a double tax agreement. Now, the general rule where there's no exemption, for example, you always keep in mind, if you are subject to tax in that country of source, your resident country, even though it may tax you on your worldwide income, it'll give you a credit generally for those taxes levied in that country. Think of it as a top-up. You should not pay more than the higher aggregate rates of tax between the two countries. Now, more of a general point, I suppose, is that larger question of setting up a structure versus investing in your personal name. And we get asked this question fairly frequently, and the answer is the perfect answer from a lawyer always: it depends. There are cogent reasons to use a structure when investing rather than having the assets in your personal name, for sure. Asset protection and legacy reasons may be applicable in some cases. But if your primary reason is to pay less tax, then at times it can be best to keep your assets in your personal name to avoid tax leakages where that's an issue, which is not in every case. Other factors such as your exit strategy and the intended retention period of that investment may also be important factors. But purely from a tax computational perspective, unless carefully considered and carried out, structures may be less efficient. You can look at this from a CGT perspective, where individuals, at least in South Africa, get preferable treatment from an effective tax rate perspective, but also keep in mind that where you use a company to hold your assets, you open the door to potential corporate tax issues unless it's properly couched and managed, such as how many of these options are. First of all, if you, together with other tax residents, hold more than 50% of the shares in a foreign company, the company will be classified as a controlled foreign company, which means that if it's in a low tax jurisdiction, usually not the US, and has no substance, the profits of that company can be imputed to the South African resident shareholders. Now, most countries around the world will have a version of this rule. The closest to us are indeed the United States and the UK, among one or two others, with this formulation of that rule. So it's normally an issue if you set up an entity in a tax haven, but the United States tends to be accepted as having true substance. But again, it's a case-by-case determination. Overall, these concepts are quite complex, and they do need a deeper understanding of tax. But it's important to consider if you'll have a considerable stake in a company, where you're actively involved, Are you involved in its operations or management? What is your percentage? The question really does depend on your factual circumstances and your intention across the short, medium, and longer term. No stone is left unturned in that regard. Generally, for tax, if you need a structure that's more simplistic, then it's more beneficial to keep the name. It's a discussion that must be had with each person.
Definitely. Thank you so much for that overview, Tom. And for those questions of Tom or Joshua, who's also off camera, you can reach out to tax consulting directly. We're happy to give you their contact information, set up a understand how they might be of service to you with your specific personal tax questions or needs.
I think also, Gabriella, there's two things. One is Jaswin specializes in also helping people if they're wanting to debate with the taxman the amount that they need to invest. So where you can actually effectively argue what you need to invest. And I'd love, Jaswin, just for you to talk about that, because for every cent you can save our investors means a cent they can invest in their freedom.
Yes, Scott, very much so. So what Scott's referring to is, for example, every single one of us wants to minimize our tax obligation. All right, but that's not always the case. When it comes to SARS, they're trying to get as much out of you as possible. However, that being said, in terms of assessments raised and taxes raised, if SARS were to raise, let's call it R1 million, and you can outright say, you know what, I do not have R1 million to pay these taxes at this stage. My financial situation does not justify it. Or alternatively, that, you know, if you just think SARS is being ridiculous and you don't actually owe that amount of money to SARS, you do have avenues available. One of which is the compromise of tax debt. So under the compromise of tax debt, if you owe SARS R1 million, according to SARS, and you can justify and your financials can substantiate that, in fact, all you can afford to pay is $500,000, we can then engage SARS on your behalf to tell them that physically and financially, the taxpayer cannot afford the entire tax liability. And upon success, what happens is SARS will send through an agreement. Once the agreement is signed, they will write off the other $500,000 in liability upon you making payments of the $500,000 that was proposed to SARS as settlement. However, in the alternative, if SARS has raised an assessment and you believe it is totally inaccurate, we will then formally engage them on the dispute side in the form of a request for reasons. And once those reasons are obtained, a notice of objection substantiating the grounds on which you are disputing the liability and why it is that you feel that this is not owed to SARS. Both of these mechanisms are available to all taxpayers. And regardless of whether it's 100,000 or 10 million in liability, SARS is still open to engaging in these sort of resolutions, because not only is it more expeditious on their side than to engage in back and forth collection measures, but also it provides a greater return for the fiscus. And in light of the current pandemic and the deficit in the fiscus, SARS is all for receiving something instead of nothing.
No, brilliant. Thank you very much. I'm not sure who the best person is to answer this, but Faisal's asked a question. Upon death, does individual investors need an overseas will, or does an SA will hold overseas?
So with regards to the will, a single will suffice. However, what must be noted is that in the event where assets are held offshore, it is ideal to actually have more than one executor, one dealing with the local assets and one dealing with the offshore assets, as it does expedite the process in finalizing and preparing the liquidation distribution accounts and just that final closure of the estate.
Brilliant. Gabriella, anything else? Sorry, I'm just looking through the questions here in terms of it. I mean, I think it's so interesting because when it comes to tax and what Joshua and Tom have been talking about is that when we had the live events, obviously everyone came to you and wants to talk and have those individual conversations. In the virtual environment, it's a little bit more tricky. So what is the best way, Gabriella, for people to reach out and to be able to talk with our team at Tax Consulting, or our partner, is probably a better word, at Tax Consulting?
So I would say get in touch with us and we can direct you to the best contact within Tax Consulting. We work very closely with Roxana Naidu, who is an admitted attorney at Tax Consulting. She will be that point of contact for all of our clients, taking that first call, understanding their needs, and then directing them to the experts within the Tax Consulting camp, and that could be speaking with Tom, it could be speaking with Joshua or any of their other colleagues, depending upon the mission at hand, what is needed or required from that individual client. But first point of call is to get in touch with us, and then we will direct you to Roxana to schedule and ensure that you have that consultation call with Tax Consulting.
Oh, brilliant. Thank you very much. Well, I'm not sure, Gabriella, if there's anything else from your side from the two gentlemen. I really appreciate them being here, and apologies for us running a little bit over. Gabriella and I aren't used to being live with Rion. I must admit, I thought Rion added real value, but it meant that with that value, we were a little bit over. So apologies to the two of you for your time, but hopefully people can see the substantial quality of the partners we've got behind us to help in all the different areas.
Yeah, no problem at all, Scott. Always happy to be a part of these sessions. They do add great value, and that I can definitely agree with. And Tom is of the same mindset.
Excellent.
Wonderful.
Thanks. So Gabriella, back to yourself, and then when you're done, I'll wrap us up.
No, that's it, Scott. On my end, if anybody has questions on any of the investments we ran through today, please feel free to get in touch with us at invest@wealthmigrate.com, or myself, Gabriella, at wealthmigrate.com, and we can begin your journey there. So thank you so much for the time, Scott. I appreciate it, and thank you to all of our attendees for their time today in this seminar.
Fantastic. Well, listen, Gabriella, thank you very much. And I want to repeat here, you can see it behind me. We spent the morning on the why, and you very much got how and the what. And I think with both the team at Tax Consulting and Rion, you've gone into the depth behind it. And I think one of the things that I appreciate with people is that they've given up 4 hours of their time this morning, which is their most valuable asset. And for those watching the recording, the same thing. And yet it's really hard to explain the depth in a 10-minute interview or a quick YouTube video or whatever it is. So the purpose of today was to provide people with substance. You can see on my screen here, you've got the team, and there's quite a bigger, substantial team behind. This is the client-facing team in terms of the process. And I recognize, Gabriella, we need to update this as well, because I know you've got some new team members that have been joining yourself in terms of where you're at. But again, to remind you, you've been dealing with Gabriella from a wealth consultancy perspective, Alex and Fritz, and then Siska and Ruth are assisting with regards to KYCing, onboarding. For the lady that was saying, can I invest in a deal? I want to get started. My attitude is, you've heard from Rion, there's a plethora of good deals coming through. I love the fact that we've now got office, industrial, medical, and multifamily, and not just so you've got diversity across asset classes, you've got diversity across countries, you've got diversity across assets, but also something I love is you've got diversity across partners. Let's just for hypothetically say Feltman doesn't deliver. You don't have all your money with Feltman, you've got it with different partners, which I think is really, really critical to look at. So in conclusion, I just want to wrap us up. We started this morning talking all about this book, Rich Dad, Poor Dad. And we went into, whether you were a beginner, an intermediate, or an advanced, we could literally help you get to your goal. Or more importantly, you can help yourself get to your goal. We've kind of tried to show you that the last 20-something years of quite a lot of pain, a lot of money, a lot of dedication has been trying to take this book. And I think the old way of doing it is you could run out and you could buy some houses and apartments, and hopefully you would get to your goal. I think now with technology, hopefully Gabriella and her team have shared another way of doing it where it's a lot safer and a lot simpler. I wanted to finish with a story, and this was a picture of me with Richard Branson on Necker Island. I had the privilege of actually going there twice. and spending a week with him each time, a week on the island. And one of the reasons I did it is that I've spent the last 2 decades or more trying to learn from the wealthiest people in the world. What do they do? Like the most successful, what do they do? How do they do it? What is their mindset? What are their ways they do it? What are their fundamentals? And that's why I tend to joke that he's a wealthy person and I'm a wealth hacker. And I would argue that we're all wealth hackers. You know, we're trying to find the fastest, most effective way to be able to get to the end result that we as individuals are looking to achieve. And, you know, my invitation to all of you is, you know, become a wealth hacker. And well done for being on this webinar. It's certainly a step. You know, one of the things that we've tried to do is synthesize all of the training that we've done and give you a place to get started. And I've put the different links in, but if you're wanting to do that 4-step wealth formula, it's literally less than 60 minutes. It was set as a challenge for me by Shane, our colleague, so that people can get started. And most importantly, you can have a plan. Because if you're overwhelmed today when Gabriella is showing you and Rion are showing you 3 different deals, and that's just 3 different deals that are available and coming, you've got to realize that it's less about the actual deal and more about your plan, and then the deals fitting into your plan, and then it becomes a lot easier and a lot less overwhelming is the right way. And I speak from my own experience there. Speak to the team, you know, reach out. This is I know Gabriella's already shared the details, but this is the link. Speak to the team, engage with us. You know, I always joke, we're a digital company with a human heart. Talk to us. And then, you know, if I've learned one defining difference between successful people and unsuccessful people, even if I look at my own friends, people that are close to me, it's the people that take action that make a distincting difference. So if today, you know, something that you enjoyed and it resonated with you, take action, get started. You know, your worst case scenario, if you fund your wallet, is you can take your money out. You haven't invested in a deal. Do one of the education courses, join the Wealth University. It's free. Go and join it and sign up and join the groups. At the end of the day, take action, because like I taught you with Tony Robbins earlier, you can come today and have all the theory, but if you don't take action, it's going to be absolutely pointless. And so how would your life be a year from now if you were working on the belief, the knowledge, the access and the investment, the system, the support and the accountability, and ultimately the results and freedom? And remember what we spoke about with regards to the upward spiral. Just imagine that difference, and remember that repetition is the mother of skill. And I love that saying. You know, you might have heard this before. In fact, today I'd be surprised if a bunch of these things you hadn't heard of, because they're fundamentals. But what's interesting is that if you're not doing it, then you don't know it. And so, in conclusion, our aim is to put smart investing in every single person's pocket. That's what we see. You know, we all got smartphones, smart TVs, smart computers. Why shouldn't we all be investing using technology and ultimately benefiting from smart investing? And those are the next steps. If you want to get started on the Wealth University, there's the link. If you want to go directly to Wealth Migrate and start investing, there's the link. You know, our invitation is to start investing globally and ultimately to become a global citizen. You've got all our contact details. I will drop them in the chat box. There's a whole bunch of links that I'll just drop in the chat box now so that you've got the extra resources. But in the final minutes, and I am conscious of the fact that we said we would finish within the 4-hour period, I'm happy to stay here as long as needs be if there's any questions. So please just ping us through if there's any questions that you got. I'll leave the screen up and ask if there's anything that I haven't answered. If you have put a question and we've missed it, I apologize. Please just repost it. So Celeste said, thank you for all this value. No need to apologize. Thank you, Celeste. It was actually mainly from the team from tax consulting, because we were a little bit late with them. Rachel said, Rion is nuts and bolts, man, and it's good to have him on. 100%. Rion has added tremendous value to our team, both on the sponsor due diligence side and also on the compliance regulatory side. He's been a real value add to our team. Thanks for all the personal messages. Due diligence process is top quality. Yep, thank you, Richard. And I think something that we need to shout from the rooftops about. Just by the way, before I go into any more questions, if you thought this added value to you, do us a favor and write us a testimonial, or even make us a video, even better. I will speak to the team about coming up with a competition as to who anyone that kind of gives us a testimonial, we'll put them in a drawer and we'll find something of value. Because at the end of the day, you've invested 4 hours of your time. We're doing our best to add value to you. And equally, if you've got constructive feedback, we're all ears. But please give us testimonials, share with others. There's a recording later this afternoon, this evening. It's 4 p.m. UK time, 5 p.m. South African time. Although it's a recording, the team will be interactive and answering questions as well in a live environment. Thank you. As always, it's been very helpful. My profile is set up and verified. Now to fund my wallet. So exciting. Completely agree. When will you be offering us the chance to diversify across currencies as all investments? So Kerry, it's a great question. We are already diversifying across currencies. So I invested in the Portugal deal a couple of weeks ago. That's a euro-based deal. Even though we've got dollar-based wallets, remember you're investing in a euro-based deal. So you are already diversifying across currencies. We, with time, will bring out our euro-based wallet, our pound-based wallet, but each one of them costs money. Remember, we're giving you the wallets for free, no fees. Someone is paying for that. That's us. And so we believe that we just want to get to critical mass. But even though we're using US dollar-based wallets, every asset you invest in a different currency is held in that currency. So if you invest in Portugal in euros, you are investing in euros. Do you provide a statement of account for investors from other countries? Good question. I'm not sure, Gabriella, if you can answer that for me. Kathy, if I don't know the answer offhand, but I can definitely find out. And our aim is to always try and make it easy for investors. So we'll, if someone can answer that for me, otherwise I'll come back to you. Thank you for the positive words. Tony, thanks, Scott. This was a good session. I'm already an investor. However, it was good to get an understanding of how you choose partners. Thank you, Tony. And I think, as I said, Rion and Gabriella and the team, we need to figure out a way to share that more. Great. And I think that's it. So I'm just going to look here. We've got 3 minutes now until the hour. If there are any more questions, let us know, and we will run to those questions. And if not, I'll give you 30 odd seconds just to see it. I'm going to just remind people of the different resources. So this is where you can start if you want to get started with the 4-step wealth formula. And I've just got to tab through the screens here. You've got the Wealth University where you can go in and you can join all the different groups. You've got the different courses where you can do the investor test. As I said to you, you can go and read all about it. This is based on the I Ching. It's based on the fundamentals of investing. So it's literally more than 6,000 years worth of knowledge that have been brought together, and it's nature's principles. And then you can actually go on your own investment personalized journey based on your investor test. You've got the resources that I've shared with you, and then you've got, sorry, I want to just open up. You've got Wealth Migrate, which is the platform, and you can literally go in, log in as Gabby showed you, and go into the platform and actually start investing in the actual deal. So you've hopefully got all the different resources in terms of where you're looking at, and hopefully that helps. I will just quickly, I will put them in the chat box just now as well. Jan Kraus has asked, does most of the investment returns pay out quarterly? Jan, great question. If it's a growth project, then it pays out at the end. If it's an income project, then generally they pay quarterly. And again, when you look at a deal, it just happens that I've got it here. You can actually see that when you're going in, you can see the cash flow, and you can also see if you go to the investment calculator here, that when I go into it on the calculator, you can see if it's paying out returns quarterly, etc. So it just gives you that breakdown. So on every single deal, you can go in and check. But hopefully, Jan, that helps you. Yeah, so thanks. Gabriella has also answered that. Gabriella, just if you can just make a note that we need to get back to Kathy, so I'm not pronouncing it right, but Giorgio, around tax statements for all investors. Oh, I see you have replied. Sorry. Great. Thank you very much, Gabriella. If we don't, in fact, collaborate on the app for which I have a framework and IP, I'm not a techie, on the version of the app and development outline, secondary project is that fund, financial. Okay, so Jay, thank you very much for your comment. I mean, you've got my details if you want to reach out to me directly. But I think the whole idea, if I understand your question correctly, is that we're helping people invest in alternative investments. So we do have structured notes as well. 80% of our focus is on property or real estate, primarily commercial property or real estate, because that is what people understand. We are venturing into some other alternative investments, but for now, we're wanting to keep it simple. And as I said, Gabrielle already showed you today, we've done 2 structured notes as well. Okay, so ladies and gentlemen, I think that's enough. I'll finish off here. I'm going to go back to our PowerPoint with the different resources. Thank you very much for your time. I can see that we're on the hour. Really appreciate all of you being here. Please share it with others. Send us a testimonial if you believe that we've added value. And most importantly, you know, you've heard all day of the 6 steps. We went through the why, the how, and the what. We've hopefully given you the formulas so that you can go out and create the freedom that you want in your life. That is what we're passionate about. And we just help, you know, what we like to do is help you unlock the key to that freedom for yourself. So thanks for your time. We really appreciate it. We look forward to seeing you online in the near future. And most importantly, we look forward to seeing your personal results. Please let us know about them. Cheers.